Yes, students, now we will revise the most important head under the income tax, that is profits and gains from business or profession. In short, we also call this head as PGBP. Section 28 to 44D of Income Tax Act contains the provisions with respect to PGBP, but every section is not a part of your syllabus, guys. So whatever is covered in your syllabus, we'll be learning each one of them in detail. Section 28 being the charging section specifies that any profit or gain earned by the assessee from his business or profession carried on by him at any time during the previous year will be taxable under this head. Even if assessee has carried on the business or profession for 1 month, 2 months, or for few months during the previous year, whatever he or she has earned from it will be taxable under this head. In addition to this, even there are few more items which are listed under section 28, guys. For example, compensation which is received for managing the affairs of a business is taxable under this head, provided that person is not under the employment. Same way, the compensation received under the agency contract or for the termination of agency contract or compensation received for termination or modification of any contract will be taxable under this head. In addition to that, even subsidy or any incentives received in order to support the business will be taxable under this head. Yes, sir. And even if I have agreed not to carry on any business or profession for which you are paying me non-compete fee, even that would be taxable in my hands under the head PGBP. There are few more special items here. That is, now assume I am a partner of a partnership firm, and if I am receiving any amount in the form of interest, salary, bonus, commission from the partnership firm, anything which a partner receives from partnership firm will be taxable in the hands of partner under the head PGBP, guys. And whatever is allowed for the firm as an expenses as per section 40B will only be taxable in the hands of partner under the head PGBP. I will just explain it here. You can see, yeah. Assume there is a partner of partnership firm and partnership firm is paying to the partner interest on capital or interest on loan at 15% per annum. 15% per annum, and they are also paying the remuneration, that is in the form of salary, 10 lakh rupees per annum for the partner. Okay. So partner is actually earning 15% interest and 10 lakh remuneration in a year. But as per section 40B, a partnership firm cannot claim whatever they are paying to the partner as an expenses, guys. There is some limit. Maximum interest which is allowed as per section 40B is 12% per annum. Okay. So partnership firm can claim, even though they are paying 15%, they can claim only how much? 12% interest as an expenses. Same way, even though they are paying remuneration 10 lakh, we need to check what is the limit prescribed under section 40B. Now let us assume the limit prescribed as per section 40B is 8 lakh. So what is allowed as an expenses for the firm is 8 lakh or 10 lakh, whichever is lower. So they can claim how much, people? 8 lakh and not 10 lakh. So 12% interest and 8 lakh is allowed as an expenses for the firm. No? So the same thing will be taxable in the hands of partner under the head PGBP, guys. Even though partner might be receiving this amount, but still, whatever is allowed as an expenses for the firm as per section 40B, 40B we will be learning in this head. So whatever is allowed as an expenses for the partnership firm will be taxable in the hands of partner as what? PGBP. So I repeat once again, whatever is allowed in the hands of partnership firm as an expenses while computing the business of income of the firm will be taxable as business income in the hands of partner. Okay, sir. Then, if partnership firm, after paying all the tax, if they are distributing any share of profit to the partner, then this share of profit is already after paying tax in the hands of firm, no? So, the share of profit will be exempt in the hands of partner as per section 10 clause 2A, guys. Section 10 clause 2A. Share of profit only will be exempt. Whereas if partner is receiving interest remuneration from the partnership firm, that would be taxable, guys. Clear? And accordingly, share of profit will not be allowed as an expenses for partnership firm. That is the amount which the firm is distributing after paying a tax, guys. Okay, sir. And there is one section which is introduced under the TDS, guys. See, all this I would be covering it later also, but as it is connected, I'm trying to explain it in one place, guys. Now, Partnership firm, whatever interest and remuneration they are paying to the partner, no, they are also supposed to deduct TDS under section 194T at 10% on the actual amount paid. Even though the firm can claim only this much expenditure, they are supposed to deduct TDS not on this. They are supposed to deduct TDS on whatever actual amount they are paying. And this is a new section which has been introduced, guys. So amendment part, please take care, and I will explain this in detail when I go to TDS topic. Fine, sir. Then also there is one more special item covered under section 28. That is, guys, assume I am a furniture dealer. So what is furniture for me? Stock. So if I sell a stock or inventory, where is it taxable for me? Under the head PGBP. But what if I convert stock into a capital asset? I started using furniture as a fixed asset for my business. In that case, they are telling in section 28, they are telling whatever is the fair market value of the stock which is converted into a capital asset on the date of conversion. Assume the date of conversion is on 1st October. The fair market value on that day of the stock is 5 lakh. That will be taxable under the head PGBP, guys. That will be considered as sale value of the stock to compute business income. Okay, sir. Now, there is a capital asset. Fine. In the future, if this capital asset is sold, then the cost of acquisition would be 5 lakh. Whatever was taxable as business income when the stock was converted into capital asset will now be allowed as cost of acquisition. For which asset? For capital asset. For capital asset. Sir, no, sir, we are not selling this asset. This asset is used in business. Can we claim depreciation on it? Yes. And to claim depreciation, what is the value of the asset which has to be added to the block? It is 5 lakhs. It is 5 lakh. Is that clear? Yes, sir. Fine. Let us come back. Now, section 29 is talking about the computation of income under this head for income tax purpose. Guys, very important. Now, the assessee would have already maintained the books of accounts. He would have already prepared the financial statements and already computed financial profit or accounting profit. But will we take that straight away as taxable business income? No. We will consider the accounting profit as the base, and we will try to compute what is the taxable business income or professional income of an assessee as per the income tax provisions. As per the income tax provision. So we are supposed to calculate the taxable business income by following the provisions given under the income tax law along with ICDS. Along with ICDS. Okay, sir. And in the Income Tax Act, they are given what expenses are allowed under section 30 to 37 and what expenses are not allowed is given in section 40, 43B and all. So we need to take care of all this and then compute the income under the head PGBP, guys. And this is very, very important. Guys, you know, there will be total income question asked in your exam. And in that total income questions, the main target would be on PGBP head. Clear? So we'll be learning in detail what expenses are allowed, what expenses are not allowed. But before that, I will just go through the format. Yes, guys, as per section 145 of Income Tax Act, assessee while computing the income at the head PGBP and income from other sources can follow either mercantile system of accounting or cash system of accounting, whichever he or she is regularly following for accounts purpose. Got it? But section 145 capital B will tell two income will always be taxable on receipt basis. What is it? Interest on compensation or enhanced compensation which is received in case of compulsory acquisition will be taxable in the year in which it is received. And where is it taxable? Under other sources. Same way, if assessee is receiving any subsidy or grant from the government, it will be taxable in the year in which it is received under the head PGBP, guys, irrespective of the method of accounting followed by the assessee. For any other income or expenses, we can follow either the cash system of accounting or mercantile system of accounting, whichever the assessee is regularly following for maintaining the books of accounts. For computing which all income? For computing the income under the head PGBP and income from other sources. So along with income tax provision, the assessee is also supposed to follow something called as ICDS. The full form of this is Income Computation and Disclosure Standards. Sir, who should follow this? Should everyone follow this? No, guys. I have just given one chart here. Just observe. Who should follow ICDS? Applicable for computing the income under the head PGBP and income from other sources. for the assessor who is following mercantile system of accounting. That means if I am following cash system of accounting, no ICDS, no, but I should follow income tax provisions. Okay, ICDS is along with income tax provision. So who should follow ICDS along with income tax provision means only those who are following mercantile system of accounting for tax purpose. Okay. And is it applicable for all the people? No, no. For individual or HUF who is subject to tax audit, only for them it is applicable. If they are not subject to tax audit, then ICDS is not applicable. Okay. And for them, is income tax provision applicable? Yes, income tax provision is applicable for everyone. What we are now talking about is ICDS tax. Okay, sir. What about others like company, partnership firm and all? For them, always ICDS is applicable provided they are following mercantile system of accounting, guys. Got it? Yes, sir. Now, let us see the computation format. So, whatever profit is already calculated for accounting purpose, we will take that as a base, guys. Normally, this will be given in the question. Okay. Yes. We will take that as the base and make necessary adjustments. And this necessary adjustment is as per income tax provisions, which we'll be learning after this. Okay. But I will just explain the format. Okay. So, under addition, there are three items which I have given. What are those? One by one. First, expenses are losses which are disallowed but debited in P&L account. Now, sir, if there is any expenses which is already debited in P&L account because of which our profit has come down, okay, assume this is P&L account, there is an expenses which is already debited because of which the profit has come down, but now under the Income Tax Act they are telling this is disallowed. This is disallowed. So now what should I do? Add back. Add it. Next, income taxable as business income but not credited in P&L account. So there is an income which is taxable under the head under Income Tax Act under the head PGBP, which is given in adjustments. Okay, assume bad debt recovered. Bad debt recovered is taxable as business income. Yes, but it is not credited here. So because of which my profit is same. It has not increased because if it was credited here, my profit would have gone up. Correct, but it is not credited. So what should I do now? Add it. Add it. Clear? Yes. Then expenses in excess of allowed amount debited in P&L account. For example, assume in P&L account an expenses is debited 60,000, but as per Income Tax Act only 40,000 is allowed. Only 40,000 is allowed. How much excess has been debited, guys? 20,000. So that 20,000 has to be debited, added back. Whatever excess debit is given, we need to add back that. Okay, sir. Then coming to the deduction items, expenses or losses allowed but not debited to P&L account. Okay, sir, there is an expenses which is actually allowed but it is not debited to P&L account. Somewhere in the adjustment it is given, sir. So that means my profit has not decreased because of it. So what should I do now? I should deduct it. I should deduct it. Next, incomes which are not taxable as business income but credited to P&L account. Okay, guys, in accounts we don't have any segregation like, sir, this income is taxable under that date, this date and all. Anything which an assessee has earned will be credited to P&L account or it will be considered as income in P&L statement. Correct? Yes. So now assume in P&L account all in dividend income, interest income, rental income, everything is credited. No doubt these incomes are taxable but under different head. So because of this income, our profit has gone up. So what should I do now? Deduct it. We need to deduct it. Okay, sir. Next, incomes which are exempt from tax but credited to P&L account. Now assume agriculture income is credited to P&L account because of which profit has gone up. But as per Income Tax Act, agriculture income is not taxable. It is exempt as per section 10 clause 1. So what should I do? Deduct it. Deduct it. Because for accounting, we don't follow any concept of exemption and all. Correct? Anything we earn, we will credit it to P&L account. Clear? Yes, guys. Sure. So ultimately, we derive income from business or profession. And sometimes, if they are asking you to calculate the income from profession, if they are just given the receipts and payments, then you can just simply take receipts and claim all the payments, whichever is allowed as per Income Tax Act, you will get taxable professional income. Taxable professional income, guys. Is that clear? So for this purpose, you should be knowing what expenses are allowed or what expenses are not allowed for income tax purpose, guys. So now let us learn. Section 30 to 37 of Income Tax Act will tell what expenses are allowed while computing the income under the head PGBP, guys. So let us learn one by one. First, section 30. Expenses of business premises. Business premises here is nothing but the building in which the business is carried on, guys. It might be office building or factory building. So if there is any revenue expenditure incurred with respect to the building, then it can be claimed as an expenses as per section 30. But the condition is the building should be used for business purpose or profession purpose. Okay. Then any other assets is covered under section 31. So if there is revenue expenditure incurred on any other assets like furniture, plant and machinery, or any other asset which is used for business purpose, then such expenditure can be claimed as deduction as per section 31, guys. Sir, what about capital expenditure? You have just mentioned only revenue here. Guys, if building or furniture or plant and machinery or any other asset is owned by the assessee and if it is used for the business purpose, then that capital expenditure, whatever he has incurred to purchase it, will be capitalized and on that depreciation will be allowed as per section 32. As per section 32. Yes, now we will get into section 32, the most important section, guys. So please be attentive. Yes. Section 32 talks about depreciation, and please be careful, the depreciation concept under Income Tax Act is different from depreciation calculation what you would have learned in accounts. Whatever you have learned for accounting purpose will continue the same for accounting purpose, whereas under Income Tax Act it is different. Okay. So this section provides for compulsory deduction on account of depreciation. And every assessee is supposed to follow WDV method for charging depreciation under the Income Tax Act as per section 32, except only the assessee who is engaged in electricity business or power sector can follow either WDV method or SLM method. They are free to follow either WDV method or SLM method. And for the assessee, whoever is charging the depreciation as per WDV method, that is except electricity company, everyone has to follow WDV method. For them, the rate is as per income tax rules. And there, the depreciation is claimed on block basis, guys. So what is the rate of depreciation? I have given you. You can just have a look into it. And you are supposed to remember these rates, guys. Okay. What are those, sir? So there are two main category of assets, tangible and intangible. Under tangible, there are three subcategory. What are those? We will see one by one. Okay, first building. Building, if it is used for residential purposes, the depreciation rate is 5%. Then if building is other than above, that is like office building or factory building, then it is 10%. Now you might ask me, sir, building if it is used for residential purpose, then it is personal in nature. That means we cannot claim depreciation. Yes, if any asset is used for personal purpose, no depreciation is allowed. But a company can own an asset which they can use, which they can give it to their employees to use it for their residential purpose. So in such case, can company claim depreciation on it? Yes. Many companies will have staff quarters or the building which they would have given to their employees to stay. Can they claim depreciation for it? Yes. It is considered to be used for business purpose, guys. Is that clear? Yes, sir. Okay. Then whatever is covered under 10% category is like office building or factory building, guys. In the question, if they have just given building, please follow 10%. Okay. Then furniture and fittings, including electrical fittings, the rate of depreciation is 10%. Then plant and machinery, this is the third category under tangible assets, and all the assets whichever will not fit in under building and furniture and fittings will come here, guys. Okay, but the rate of depreciation is different. So what is it? Motor car, motor buses, motor lorries, motor taxis used in the business of running them on hire. So I am in the business of giving the any of these assets or any of these vehicles on rent or on hire. Then the usage would be more. So that is why the depreciation rate is 30%. Sir, what if it is motor car other than the above? Then it is 15%. Sir, I am just using motor car for pickup and drop of my employees as cab facility. I am not giving it on hire. In that case, as motor car is used for business purpose, depreciation can be claimed, but at 15%. Okay. Then for ships, it is 20%, aeroplanes and aero engines 40%, books, computers, including computer software, renewable energy saving devices, including electrical vehicles, it is 40%, guys. Okay. So for three assets here, it is 40%. Then the general rate for plant and machinery, if simply they have just mentioned plant and machinery in the question or just machinery, please charge depreciation at 15%. Then the second main category, that is intangible assets, including the copyright, patent, trademark and all, the depreciation rate is 25%. But one important thing is, guys, actually goodwill is an intangible asset. But under Income Tax Act, depreciation is not allowed on goodwill. Depreciation is not allowed on goodwill. Whether it is self-generated or purchased, doesn't matter. No depreciation on goodwill, guys. Okay. So whatever rates we just now saw is actually given in income tax rules, people. Okay. Now let us understand what is the format to compute the depreciation or the return on value of an asset. As I mentioned you, every assessee is supposed to follow which method of depreciation, guys? WDV method of depreciation, where the depreciation would be charged on block basis. That is the group of asset having the same rate of depreciation and same nature. Okay, so they all will be combined and made one block, guys. Okay, whereas the power sector or the associate who is engaged in electricity business can follow either SLM method or WDV method. They have the freedom to follow any one of them, but once they choose any one, they have to continue with that. And under SLM method, the depreciation would be charged on asset to asset basis and not block. Okay, sir, fine. So how do we calculate the depreciation or return on value under the WDV method? Is like this. First, take opening balance of a block as on the first day of the previous year. Okay. Then for that, whatever asset is purchased during the year, that is during our previous year, has to be added. But there we need to check the segregation, guys. So if there is any asset, you can see the B point here. If there is any asset which is acquired and put to use for less than 180 days during the previous year, then only 50% of the depreciation will be allowed, guys. 50% means not 50% rate. Whatever rate we already learned, no? Assume actual depreciation rate is 10%. So if an asset is purchased and put to use for less than 180 days during the previous year, you can claim only 5% depreciation. That is 50% of 10%. Okay, yes. And this is only for the new assets which is purchased and put to use during the previous year. If the asset was already purchased long back, then I can claim full depreciation during the previous year, guys. Okay, sir. And I have given one standard date here. That is, if an asset is purchased on or after 4th October of the previous year, then you will provide only 50% depreciation for it. Whereas if asset is purchased from 1st April to 3rd October during the previous year, that means it will be more than 180 days. It is used for more than 180 days. Can we claim full depreciation? Yes. Try to remember this date so that it will be useful for calculation. So instead of calculating the number of days in the exam, if you just know the standard date, if purchase date or if the asset is purchased and put to use on or after 4th October till 31st March, you give only 50% of actual depreciation. Okay, now, and the main condition is asset has to be owned by the assessee and it should be used for business purpose. But sir, what if asset is purchased by the assessee on hire purchase basis? You will get the ownership only when you pay the last installment. In that case, as soon as the assessee purchase the asset by paying down payment and start using it for his business, he can start claiming depreciation tax. He can start claiming depreciation. Okay, sir. Chalo. Now coming back to the format. Okay. So if any asset is acquired and put to use during the previous year for 180 days or more, take it separately. Less than 180 days, take it separately. Because on this we can claim 100% of depreciation, whereas on this only 50%. So should I show it separately? Yes, guys. Then, and how to calculate actual cost of this asset? Because when a new asset is purchased, we need to calculate the actual cost of the asset, which we need to add it here. No, how to calculate the actual cost? They have given it in the law. So how is it? I have just prepared one table here. You can have a look into it. Okay, how to calculate the actual cost of an asset which is used for business purpose? Because we need to add this value to the block. How do we determine it? Is given in section 43 subsection 1. How is it? Quickly I will see. Purchase cost of an asset, that is what the buyer has paid to the seller. Then GST paid on the purchase. We need to check whether credit is available or not. For this, if input tax credit is available under GST, then we should not add it here. If ITC is not available, can I add it? Yes. Accordingly, your capitalized amount will increase. Okay. Then any amount paid for loading, unloading, freight or insurance, installation charges, interest on loan borrowed to acquire the asset up to the date the asset is put to use. Now, if I have borrowed any loan to purchase an asset, whatever interest I am paying till the asset is put to use, I can capitalize it. I can add it to the cost of the asset. Sir, what even after the asset is put to use, still I am repaying the loan. I am paying the interest. then that interest will be allowed as revenue expenditure. You can claim it as per section 36 as revenue expenditure. Clear? So only the interest amount up to the date the asset is put to use will be capitalized, guys. After that also, if there is any interest paid, that will be allowed as revenue expenditure as per section 36. Okay. And if assessee has received any subsidy or grant to purchase an asset, then that subsidy or grant has to be reduced. Got it? So finally, we will derive actual cost, which has to be added to the block, and this calculation is very similar to your inventory valuation in costing, or even you would have calculated the cost of an asset in your accounts. No, it is very similar to that, guys. Got it? Yes. So whatever is the actual cost, we will add it here. Okay, depending upon whether the asset is purchased and put to use for 180 days or more, or less than 180 days. Guys, one thing to take care here is you might get confused with 180 days and 182 days. Please be careful while determining the residential status under section 6.1 for individual. There were two basic conditions. Under that, the first basic condition was number of days of stay in India should be 182 days or more during the previous year. There it is 182, whereas here it is 180. So please don't get confused. Oh, then, and I have also mentioned here, just a minute, I will show you. Yeah. This is with respect to GST paid on the purchase of an asset, guys. Okay, section 43 subsection 1 of the Income Tax Act has to be read with section 16 subsection 3 of CGST Act, which is a part of GST. Clear? Yes. So as you guys would be learning both of them, I will try to connect it both here. Okay, even when I am explaining GST input tax credit chapter, I will connect to this. Okay. Now assume I have purchased an asset for 10 lakh on which GST is 10%. So which comes to 1 lakh. Totally I have paid 11 lakh. Now, what is the actual cost for me as per section 43 subsection 1? In order to claim depreciation, we need to check. So if ITC is available for this 1 lakh, which I can adjust it against output tax, then what will be my actual cost of an asset for income tax purpose? 10 lakh. Because this 1 lakh benefit, I will get it in GST. I can adjust it against output tax. Okay. Sir, what if ITC is not available for this 1 lakh? It is blocked under section 17 subsection 5, sir. Or else I am not satisfied certain condition given under section 16. So I am not able to claim the credit. In that case, the actual cost for income tax purpose would be 11 lakh, including GST. Including GST. So it is either add it to the actual cost or claim credit, but not both. But not both, guys. Yes, sir. Okay. So next, we need to deduct. If any asset is sold during the previous year, whatever is the sale value, we need to reduce it. We need to deduct it. Even if an asset is put for a scrap and if scrap value is received, we need to deduct it. Even if asset is like lost or destroyed and if insurance compensation is received, we need to deduct it here. And when an asset is sold, if an asset is sold, do we calculate profit or loss on such asset? No. For income tax purpose, we don't calculate it. As long as we claim depreciation on that particular block, when any single asset or two or more assets or single asset is sold, we don't compute profit or loss on such sale, guys. Okay, sir. So we will deduct that whatever is the remaining value, we will claim depreciation on that, guys. We will claim depreciation on this value. Okay. And please be careful. If this includes any amount with respect to asset purchased and put to use for less than 180 days, then please segregate and calculate depreciation. For example, assume this is 30 lakh. Whereas out of 30 lakh, this is like 10 lakh. So on 10 lakh, you can claim only 50% of normal depreciation. Whereas on remaining 20 lakh, you can claim full. You can claim full. So whenever you are claiming depreciation, first check whether this figure includes any amount from year. If yes, give only 50% depreciation for it. For the remaining value, you can claim full depreciation. And once you calculate depreciation as per section 32, deduct it, you will get closing return down value, which will become opening return down value for next year, guys. Got it? Yes, sir. Fine. So first 2 points I already covered. Then, if the asset is ready to use, can we still claim depreciation? Yes, sir. Then D point also I have already explained. E also I have already explained. Then F. Guys, as long as we claim depreciation under section 32, if any asset is sold, we never compute profit or loss for that asset. But when section 32 fails, immediately section 50 will take over to compute short-term capital gain or short-term capital loss. And it will always be short-term in nature. And this is covered under section under capital gains head as per section 50, which we will learn in the next head of income, guys. Okay, sir. Then when to depreciation under section 32 fails is only in two scenarios. That is when all the assets in the block are sold irrespective of the value, or when there is no value in the block. When there is no value means, sir, the value in the block is either negative or it is zero. I will claim depreciation on what figure? It is not possible. Correct. For example, assume guys, I had 10 assets whose value was 100 lakh. Now I have sold all 10 assets for only 20 lakh. I have 80 lakh value, but there is no asset in the block. That means I cannot claim depreciation. Yes. Next example. Assume I have 10 assets whose value is 100 lakh. I have sold only 6 assets out of it for 120 lakh. 120 lakh. That means still 4 assets are there in the block, but there is no value in the block. So this value is negative. I cannot claim depreciation on negative value. So that means depreciation under section 32 fails? Yes, it fails, guys. Even though there are 4 assets in the block which might be used for business purpose, still we are not able to claim depreciation as there is no value in the block. So only in these two scenarios, the capital gains will be computed as per section 50, guys. Got it? Yes, sir. Then, then only for new plant and machinery which is purchased and installed in factory for the assessee who is engaged in the business of manufacture, or the person who is engaged in the power sector, who is engaged in the business of power or electricity, who is following WDV method. In addition to 15% for plant and machinery, they will get an increased or enhanced depreciation, or we also call it as additional depreciation at the rate of 20% of actual cost only in the first year. I repeat, what are the conditions? Guys, come on, listen. The asset should be new plant and machinery purchased and put to use during the previous year. And it should be installed in the factory. And it should be purchased and installed in factory by whom? By the assessee who is engaged in the manufacturing business, or the assessee who is engaged in electricity supply but following WDV method. They can claim an additional depreciation of 20% of actual cost of plant and machinery in the first year. So in the first year, they can claim 15% normal depreciation plus 20% additional depreciation, totally 35%. Whereas from the second year, they can claim only normal depreciation. So additional depreciation is allowed only in the first year in which the asset is purchased and put to use, guys. Whereas if a new plant and machinery is purchased and put to use during the previous year in factory for less than 180 days, in that case, only 10% of additional depreciation will be allowed in the current year. Remaining 10% will be allowed in the next year. But please be careful. In the next year, when you are claiming 10% additional depreciation, even though it is second year, we are still allowing you because in the first year you claimed only 10%. But that 10% will be on actual cost, guys, not on WDV. Please be careful. So in the first year, you would have claimed 10% no of actual cost. Same amount, you will again claim it in next year. This is only when new plant and machinery is purchased and put to use during the previous year for less than 180 days in the factory, guys. Hope you got it. Yes, sir. Fine, guys. So I will just do one question on this. Come to the question back. I have some simple questions also on depreciation. You guys can just go through it. You try to solve it. I have given it along with the solution. Okay. Fourth question, let me discuss because it has 4 different types of asset, guys. Quickly. Come to question number 4 in the question bank. Yes. Okay. Let me see it. First, factory building is there. Okay. The opening WDV is 20 lakh 50,000 and additions during the year is 8 lakh, which is purchased on 15th January 2026, guys. So observe the date. So it is purchased during the year, but it is put to use for less than 180 days. So how much depreciation I can claim on this? Only 50%. 50% of 10%. Correct? Yes, let us check it. So 20 lakh 50,000 is the opening value. 8 lakh is the worth of asset which is purchased and put to use for less than 180 days during the previous year. So we will get 28 lakh 50,000, but break down into two parts. On 20 lakh 50,000, which is the opening value, you can claim full 10%, whereas on 8 lakh, which is purchased during the previous year and put to use for less than 180 days, you can claim 10% into 50% of it. That is nothing but 5%. Okay, sir. Fine. So closing return on value after reducing the depreciation would be 26 lakh 5,000 for factory building. Next, the assessee also has a residential building. So how much is that? 50 lakh. So additions made during the year is 5 lakh on 31st July 2025. So before 4th October, guys. So is it put to use for more than 180 days during the previous year? Yes. And the percentage is 5%. Okay. And please don't assume that always the rate of depreciation will be given in the question. Sometimes it will not be given. So you are supposed to remember it, guys. Okay. So fine, sir. We will remember. Very good. Oh, so WDV for depreciation purpose is 55 lakh. Straight away apply 5% on it. Why, sir? Because both of them together in aggregate is used for more than 180 days. So claim full depreciation. Okay, so depreciation amount comes to 2 lakh 75, and if I reduce it, we will get closing WDV 52 lakh 25,000, guys. Then coming to plant and machinery, and observe the assessee is engaged in the business of textile. So can we consider them as manufacturing? Yes, guys. So can they claim additional depreciation? Yes, provided the plant and machinery is installed in factory. And guys, if the question specify that the assessee is engaged in the business of manufacturing, but they have not mentioned whether it is installed in factory or not, assume the plant and machinery is installed in factory, because normally the manufacturer would be using the plant and machinery in the factory, guys, because the factory is a place where manufacturing happens. Okay, opening WDV is 90 lakh. Then asset purchased and put to use during the previous year is 3 lakh on 5th October. After 4th October. That means used for less than 180 days, guys. And there is a sale value of 11 lakh, which we need to just deduct it. Then the depreciation rate is 15%. Now observe this. This is important, guys. Please pay attention. Opening WDV is 90 lakh, and the asset purchased and put to use for less than 180 days is 3 lakh. So on that 3 lakh, we can claim 15% into 15%, that is normal depreciation, whereas additional depreciation also is allowed on this. Please be careful. Please be careful. Sir, what is the amount of this? What is the amount of this? 1 second. Yes. So what is the amount of this, sir? That is 3 lakh into 20% into 50%. Sir, why only 50%? Because asset is put to use for less than 180 days during the previous year. So the amount comes to 30,000. Same amount, will it be allowed in the next year also? Yes. It might be second year, but still, as only 10% is allowed in the current year, same 30,000 can be claimed even in the next year, guys. Okay, sir. Fine. So sale value is there 11 lakh, reduce it. You will get WDV for depreciation 82 lakh. Please divide it into two parts. Out of 82 lakh, first take 3 lakh. On that 15% into 50%, whereas the remaining 79 lakh is from opening WDV. Opening WDV on that full 15%. And whenever there is a sale, guys, assume it is from opening WDV. Because student might also think, sir, what if it is this asset is sold? Guys, assessee is not in the business of buying the asset and selling it. Whenever he buy it, he will buy it with an intention to use it for the business for a longer period. So until and unless specifically given in the question, whenever there is a sale of an asset, assume it is out of opening WDV, guys. Clear? Because normally the asset purchased during the previous year will not be sold. In rare cases, it can be sold, but if it is given in the question, you consider like that. If not, please consider that the sale is from opening WDV, guys. Okay, sir. Next. Hope you got it. Then last block. Furniture and fittings. 10 lakh 30,000 is the opening value. Then there is an asset purchased during the year 1 lakh on 10th October. Again less than 180 days, guys. And there is a sale value of 3 lakh 50. So we'll assume this sales is from where? Opening WDV. Okay. So 10% is the rate. Okay, sir. So opening WDV is 10 lakh 30,000. Asset purchased during the year is 1 lakh, and it is used for less than 180 days. So on 1 lakh only 10% into 50%, and for furniture and fittings no additional depreciation. Please be careful. Additional depreciation is allowed only for plant and machinery, guys. That too subject to conditions. Okay. Fine. And there is a sale value during the year that is 3 lakh 50,000. So you will get WDV for depreciation 7 lakh 80,000. From that, reduce 1 lakh, because 1 lakh you can claim depreciation only 50%, remaining comes to 6 lakh 80, claim full 10%. Claim full 10%, guys. Okay, so the depreciation comes to 73,000 and closing WDV comes to 7 lakh 7,000 after depreciation, guys. Clear? And whenever the question is like this, sir, in the single question, will they ask so many assets? Guys, this I have just done in the class for practice purpose. Be ready. See, out of this, anything they ask, you will be able to answer in the exam when we have practiced such kind of questions. And you are supposed to give the notes like this, guys. So if you observe in my question bank, I've given solution for all the question, the way it has to be presented in the exam, guys, including notes, working notes and all. So please practice in such way. Fine. Now let us come back. I just want to talk few things with respect to SLM method, guys. Who can follow SLM method, guys? I'll just try to explain with example. Yeah. And coming to subsidy or grant, if subsidy or grant is received by an assessee to purchase an asset, while calculating the actual cost, you will deduct that amount. Whereas if subsidy or grant is received by an assessee in order to carry on his business, means someone is giving the subsidy or grant to support the assessee's business, not to purchase asset, just to support the business, then it will be taxable as business income in the year in which it is received, guys. Okay, sir. Chalo, just a minute. Now, who can follow SLM method is the assessee who is engaged in power or electricity supply. Okay, they have the option. They can either follow WDV method or SLM method. Now assume the electricity company or power sector company is following SLM method to charge depreciation, where they will charge depreciation on asset to asset basis. Okay. Now they had purchased the asset for 2 lakh and they have claimed depreciation for 2 years, which comes to 40,000. And after 2 years, they're selling the asset. They're selling the asset. And when the asset is sold, we need to check what is the sale value. So there are some special provision applicable. So please be attentive. If the sale value is 1 lakh 50, what is the return down value of the asset, guys? After charging depreciation for 2 years, 160. But assessee is selling this asset for only 1 lakh 50. So there is a loss on sale of how much? 10,000. That is 1 lakh 60,000 minus 150. So this is allowed as deduction as terminal depreciation, guys. This 10,000 is allowed as deduction in the year in which the asset is sold as what? Terminal depreciation. It is actually nothing but loss on sale of asset. Okay. Sir, what if there is a profit on sale of asset? I have given second and third scenario. Okay. So WDV of that asset at the time of sale is 1,60,000. Now assume this asset is sold for 1,80,000. So calculate what is the profit on sale, guys? It is 20,000. And what is the depreciation which is already claimed for this asset under the head PGBP? 40,000. So this is the depreciation which is already claimed and this is profit on sale. Compare both, take whichever is lower. Whichever is lower. And it is taxable as business income, which is called balancing charge, guys. As per section 41 subsection 2. It is taxable as balancing charge under the head PGBP. Okay. Next, assume sir sale value is 2,20,000. Then what is the profit on sale, guys? 60,000. Compare that with the depreciation which is already claimed, which is 40,000. Whichever is lower, 40,000. So 40,000 will be taxable as balancing charge under the head PGBP, guys. Clear? So whenever there is a loss on sale of an asset on which depreciation is claimed on SLM basis, that loss will be allowed as terminal depreciation in the year of sale. Whereas if there is a profit, compare that profit with actual depreciation which is already claimed on that asset. Whichever is lower is taxable as balancing charge under the head PGBP. Okay, so whatever is taxable as balancing charge cannot be more than 40,000, because what is the benefit which the assessee has already claimed under the PGBP? 40,000 in the name of depreciation. So maximum what will be taxable as balancing charge would be 40,000. Is that clear? And I have given here three different possibilities. All three simultaneously cannot happen, guys. Anyone. Got it? Yes, sir. Fine, guys. So we are done with the concept of depreciation. Let us move forward now. Section 35, which talks about deduction for scientific related expenditure. Now there are two set of expenditure which is covered here, people. If assessee himself is doing research, that is his business itself is to do research, whatever expenditure he is incurring, whether revenue expenditure or capital expenditure except land, will be allowed as deduction. Will be allowed as deduction. But, but there are few things to take care here. Please pay attention. Yeah. Now, once the associate has commenced the business, assume he has commenced the business on 1st November 2025, date of commencement of business. If he incur any revenue expenditure or any capital expenditure except purchase of land, he can claim 100% of that as a deduction in the year in which it is incurred. In the year in which it is incurred. And for revenue expenditure, any revenue expenditure is allowed. Okay. And section 35 is also allowing the assessee to claim the deduction for an expenditure which is incurred before the commencement of business, but within 3 years. So 3 years before this also, within 3 years. If there is any capital expenditure incurred except land, or revenue expenditure which is only of two things, that is salary to research personnel who is engaged in research, or cost of raw material which is used in research business, only those two would be allowed. Any other revenue expenditure is not allowed if it is incurred before the commencement of business. Whereas after the commencement of business, any revenue expenditure will be allowed, guys. Okay, sir. Then, and this expenditure will be allowed when, sir? If it is incurred before the commencement of business, obviously you would have not claimed it in that year. So it will be allowed in the year of commencement of business. This expenditure will be allowed in the year of commencement of business, guys. Hope you understood. So this is when assessee himself is doing research. So it is given here, you can see. Okay, so even pre-commencement expenditure is covered, but for capital except land, whereas for revenue, if it is pre-commencement, only salary for research personnel, that too excluding perquisites, then cost of raw materials. Only these things are allowed, guys. Got it? Yes, sir. So if I have to read this section also, so you can see 35.1.1 talks about revenue expenditure of an assessee who is engaged in research business, whereas 35.1.4 talks about capital expenditure except land. For land, deduction is not given here. And for land, even depreciation cannot be claimed. And once 100% of the capital expenditure is allowed as deduction here, can assessee claim depreciation on it? No, no, no. Depreciation is not allowed. Clear? Because 100% benefit is allowed under section 35 itself. Okay, sir. Then, what if assessee is contributing to the outsider who is engaged in research? Can he claim it as business expenditure? Yes, 100% of that amount is also allowed as deduction, guys. But if the assessee is following default scheme under section 115 PAC, then this is not allowed. This is not allowed. So this means this is allowed only for the assessee who is following optional scheme. So that also is covered here. Let us see one by one. It is mentioned. Yeah. 35.1.2 contribution to approved research association, college, institute and university for scientific research. Next one, contribution to Indian company for scientific research. Next one, contribution to approved research association, college, institute or university for social science or statistical research. And the last one, 35.2 AA, contribution to national laboratory IIT for scientific research undertaken under the approved program. All of this is 100% allowed as deduction while computing the income under the 8 PGPP, even though it is nowhere connected to the business of assessee. Even though it is nowhere connected to the business of the assessee, can he claim it as business expenditure? Yes, guys. But only key point here is you cannot claim it if you are following default schemes. Got it? Yes, sir. Next, I have given one point here. If an asset on which deduction is claimed under section 35 for capital expenditure on scientific research, then if it is sold later, then the tax liability will be as per section 41 subsection 3, guys. So for section 41 talks about deemed profit. So if an assessee purchase an asset for scientific research, claim deduction under section 35 and then sell it, it is like he is misusing the benefit given to him. Yes. So in such case, when he sell the asset, we need to compute the income as per section 41 subsection 3. So what is section 41 subsection 3 is telling? Let us just analyze it. Just a minute. I will explain it from my provision book. Yeah, you can see here under section 41, which talks about deemed profits, we have subsection 3, which talks about sale of scientific research asset. So there are two scenarios there, guys. If an asset which is purchased for scientific research purpose And if an assessee has claimed deduction for that capital expenditure under section 35, and if he has sold it without even using it for scientific research business, then whatever is the sale value or the deduction claimed under section 35, that is for capital expenditure, whichever is lower will be taxable as business income. Whichever is lower is taxable as business income. Sir, what if assessee has used it for scientific research business for few months or few years and then sold it? Guys, when assessee has purchased the asset for scientific research business, he will claim 100% deduction under section 35. Yes, sir. Then we will add this asset to the block. Yes. But what would be the cost? Nil. As he has already claimed 100% deduction, the cost to be added to the block for depreciation purpose is nil. And in the future, after few years, assume this asset is sold, automatically depreciation under section 32 fails because there is no value in the block or there is no asset in the block. In such case, we need to compute short-term capital gain or loss as per section 50, guys, which we will learn under the capital gains head. Got it? Yes, sir. Guys, if you feel that these classes are helping you in your preparation, why don't you give like, why don't you hype this video? Come on, it will not cost you anything. Yes, let us get into the next section, that is capital expenditure of specified business, section 35 AD. Let me try to explain that again with an example here. Yes. Guys, if assessee is doing any specified business, under section 35 AD, they have given the list of specified business. Which are those? We will see it. Now assume I am an assessee who is engaged in specified business. Then after I commenced my business, whatever is the capital expenditure I am incurring, except LGF means land, goodwill, and financial instruments. For these three assets, no deduction is given under section 35 AD. Any other capital expenditure, 100% deduction can be claimed in the year in which it is incurred. In the year in which it is incurred. Sir, what if assessee has incurred any capital expenditure before the commencement of business at any time? Here there is no 3 years limit at all. Limit. At any time, if the assessee has incurred any capital expenditure before the commencement of business, except again LGF, that is except land, goodwill, and financial instruments. Guys, not KGF, it is LGF. Yes. And even that amount will be allowed as deduction in the year in which the business has commenced. In the year in which the business has commenced. Clear? So in the year of commencement of business, whatever capital expenditure is incurred before the commencement of business, as well as whatever capital expenditure is incurred in that year, will be allowed as deduction 100%. And as assessee is claiming deduction for capital expenditure under section 35 AD, on such asset, depreciation cannot be claimed because he has already taken 100% benefit here. Got it, people? Yes, sir. Fine. But please be careful, for three assets, there is no deduction given here. That is land, goodwill, and financial instruments, guys. Okay, sir. Now, what are the list of assets which are covered under section 35 AD as specified business? I will just show you guys. Please have a look into it. You are supposed to know the idea about this list. Okay, you need not mug up it. They will not ask you to list out the businesses which are covered under section 35 AD. But in the question, when they use the name of the business, you should identify whether it is a specified business or not. Okay, so you can just pause the video, go through this list, guys. Yes, hope you are done. I will continue. Okay. And sir, once the assessee has purchased this asset or any asset except LGF and claim the benefit under section 35 AD, how long should he use that asset for specified business? It is given here. Any asset for which a deduction is claimed under section 35 AD can be used only for specified business for a period of 8 years. After 8 years, can I use it for some other business? Yes, you can use it. But for the first 8 years, you have to use it for specified business. Sir, what within 5 years, sorry, within 8 years, I started using it for some other business. Some other business means which is not specified. I can call it as non-specified business. Okay. In that case, it is mentioned here. If it is used for other business within 8 years, the deduction claimed under section 35 AD will be disallowed and it will be taxable as business income as per section 35 AD subsection 7b, guys. I will try to explain this with an example. I have mentioned you. Actually, in the provision book, it is there. Yeah. So assume the assessee purchased a plant and machinery for 2 crores for specified business. He used it for specified business for 1 year, whereas next year immediately he started using it for non-specified business. That is, which is not a specified business. Okay. So in that case, whatever deduction he has already claimed last year under section 35 AD, 35 AD is how much? 2 crore. From that we need to reduce. If this 2 crore was not allowed as deduction under section 35 AD, at least you would have claimed depreciation under section 32, right? Yes, reduce that much. So on 2 crore, depreciation on plant and machinery, only normal, 15% comes to how much? 15%, 30 lakh, 15% of 2 crore. So remaining 1 crore 70 lakh will be taxable as business income in the year in which the assessee started using this asset for non-specified business. Sir, what if the asset is used for non-specified business after 4 or 5 years, but within 8 years? In that case also, we need to reduce depreciation for that many years. That is 3 or 4 years. Clear? For each year, if this asset was used for some other business, you would have at least claimed depreciation. No? How much is that depreciation? Calculate it as notional depreciation and reduce it. Clear? Now, for non-specified business, can you add this asset to the block and start claiming depreciation? Yes. So for non-specified business, whatever is taxable as per section 35 AD subsection 7b, no, that becomes actual cost for non-specified business. And for that value, we can add it to the block and start claiming depreciation, guys. Got it? Yes, sir. Fine. Coming back. Sir, okay, we spoke about usage. If the asset purchased for specified business, if it is used for non-specified business within 8 years, then what? Sir, what if it is used after 8 years? Then no problem. Nothing will be taxable, guys. Oh. Then coming to the sale. If an asset which is purchased for specified business and if assessee has claimed deduction under section 35 AD and if it is sold, the entire sale value will be taxable as business income as per section 28, not 41. 41 is for scientific research asset, whereas for specified business asset, it is 28. Whatever is the sale value, it will be taxable under the head PGBP as per section 28. Got it? Yes, sir. And whatever deduction we are claiming under section 35 AD for the capital expenditure of specified business, it will not be allowed if the assessee is following the default scheme under section 115 BAC, guys. Any effect with respect to default scheme under section 115 BAC in my revision material, I would have highlighted it in the blue color, guys. So if assessee is following default scheme under section 115 BAC, then section 35 AD deduction will not be allowed. In such case, can you add this asset to the block and claim depreciation? Yes, you can claim depreciation, but 35 AD is not allowed. Got it? Yes. And specified business is treated as a special for income tax purpose, guys. And if assessee has any loss from specified business, it can be adjusted only against income from specified business. Clear? It might be other specified business. For example, assume I am doing two specified businesses. From one I have loss, from another I have income. Can I net off the loss? Yes, you can do it. But loss from specified business cannot be adjusted against any other income, guys. Got it? Yes. Especially in the initial year, as they are allowing us to claim 100% capital expenditure as a deduction. And for this businesses, guys, for this businesses, the capital expenditure will be huge. And in the initial years, they will have huge losses. Huge losses. So that is why they are asking you to earn the income from the same business and adjust it. And this loss can be carried forward for any number of years. Any number of years. And the loss treatment with respect to PGBP head, I will cover it at the end of this head, guys. At the end of each head, I will also talk about what if assessee has a loss. Okay, fine, done with this. Next, preliminary expenses is allowed as deduction under section 35D. Okay, what is preliminary expenses, sir? Any expenses which is incurred before the commencement of business or after the commencement of business for any extension or expansion of a new unit, then such expenses are treated as preliminary expenses. Sir, how much is allowed as deduction is given here. Deduction is given for an Indian company of how much? First, we need to calculate qualified amount, guys. How do we compute qualified amount is lower of A or B. First, what is A? Higher 5% of cost of project or 5% of capital employed. Then compare that with actual preliminary expenses. Take whichever is lower. We call that as qualified amount. Will qualified amount allowed as a deduction in one shot? No. It will be allowed as deduction in 5 equal installment from the year in which the business is commenced or from the year in which the expansion took place. This is for Indian company. Sir, what about other assessee? Other than company, it is allowed only if the assessee is resident in India. That means this benefit is not available for non-residents? No, this deduction is not allowed for non-residents, guys. Okay. Again, here also first calculate qualified amount. What is qualified amount, sir? Lower of 5% of cost of project or actual preliminary expenses. And once you get qualified amount, divide it by 5. It will be allowed in 5 equal installment over a period of 5 years. Now, sir, what is cost of project? What is capital employed? I have given here in green color. Cost of project means cost of fixed assets and capital employed refers to the issued share capital, that is both preference as well as equity, plus debentures plus long-term borrowings. Guys, please be careful. Reserves and surplus is not covered here. Okay. As on the last day of the previous year, that is on 31st March, in which the business of the company commences or extension or expansion is completed. So please be careful. This figures has to be taken as on the last day of the previous year in which the business is commenced or expansion is completed. Okay. And whenever the assessee is claiming deduction under section 35D, he is also supposed to get audit report from a practicing chartered accountant along with a statement containing the particulars of actual expenditure, and this audit report has to be submitted at least 1 month before the due date of filing the income tax return. When the audit is applicable, the due date for filing the income tax return is 31st October of the assessment year, guys. 31st October of the assessment year. So they are asking you to file audit report at least 1 month prior to that. That means on or before 30th September of assessment year. On or before 30th September of assessment year. Yes, sir. I will just cover it. Okay, what are the due dates? It is actually a part of assessment procedure chapter, which we'll be learning later. But anyway, as it is connected here, I just want to mention it, guys. So let us see. Yes, here it is. Here it is. So if you want to tell me the page number 83, guys. Yeah. So this is given in section 139, guys. Due date for filing the return of income. Please be careful. This is important for PGBP head. That is why I am covering it. What is the due date for filing income tax returns? There are totally 3 dates, guys. First one, 30th November of the assessment year, where the assessee is supposed to furnish transfer pricing report under section 92E. And what is transfer pricing report and all is not a part of your syllabus. It is a part of international taxation. You will be learning that at final level, guys. Okay. Next, 31st October of the assessment year, in case the assessee is a company always 31st October, whether they are subject to tax audit or not, it is always 31st October. Okay. A person other than company whose accounts are required to be audited as per section 44AB, or a working partner of a firm whose accounts are required to be audited. So simple. For whom 31st October of assessment year is the due date is company always plus whoever is subject to tax audit as per section 44AB. So 44AB is a part of PGBP head. We will learn it in this chapter itself. Okay. Got it, sir. Any other person, 31st July of assessment year. Now, if I am an assessee who has only salary income or house property income and all, then for me the due date would be 31st July, guys. Is that clear? Yes. And for PGBP purpose, guys, if nothing is given, let us consider that the due date applicable for the assessee is 31st October. 31st October. Okay. Now come back. Come back to PGBP head. Okay, sir. Fine. So even this, I will try to explain with an example, guys. So pay attention. Hello, hello. Pay attention, pay attention. Come on. Yes. Now assume Assassi is an Indian company who has commenced the business on 1st October 2025. And actual preliminary expenses incurred by them before the commencement of business is 3 lakh. Let us assume that. Okay. When does the company prepare their first financial statements? As on 31st March 2026. First financial statement. Okay. On that day, they have prepared a balance sheet where the fixed asset is 25 lakh, current asset is 10 lakh. And on the Other side, equity share capital 10 lakh, reserves and surplus 50,000, preference share capital 5 lakh, long-term borrowing, long-term loan is 5 lakh, and current liability is 14.5 lakh. Oh. So what will be the cost of capital here, guys? It is nothing but fixed asset, which is 25 lakh. What is capital employed? We need to take only 1, 2, 3. So that is 10 plus 5 plus 5. Sir, should we not include reserves and surplus? No, guys, because this is something which is earned only after the commencement of business. So that is why they are not considering it. So we need to take 10 plus 5 plus 5, guys, which comes to 20 lakh. So calculate 5% of each. So 5% of cost of project comes to 1,25,000. 5% of capital employed comes to 1 lakh. Take whichever is higher. Then compare that with actual preliminary expenses, which is 3 lakh in our example. Whichever is lower is called qualifying amount, which is 125. Can I claim it in one shot? No. 1,25,000 will be allowed in 5 equal installments. Starting from when? Amount of deduction for previous year 25-26 is 25,000. So for the next 4 years also, 25,000 will be allowed as deduction under section 35D, guys. Got it? Yes, sir. Sir, what if it is non-company, non-corporate, that is other than company, who is resident in India, like partnership firm, or assume I am a sole proprietor? In that case, we need to take only 5% of cost of project. No capital employed will come here, which is 1,25,000. Then actual preliminary expenses is 3 lakh. Compare both, take whichever is lower. 1/5 of that will be allowed as deduction for the first 5 years, guys. This is for the associate who is not a company but resident in India. Got it? Yes, sir. Fine, we'll move forward. So till now, whatever we covered under section 35, it was some special expenditure or the expenditure with respect to some special business. Okay. Whereas now let us deal with the expenditure which is covered under section 36, guys. We call it as specific deductions. So what are those? One by one. 36 subsection 1 has the following expenses. One by one. Quickly we will go through. What are those? Insurance premium paid. If assessee has taken any insurance policy, that is general insurance policy on the inventory or stock which is using for his business purpose, whatever premium is paying on such policy, it is allowed as deduction. Okay. Next, if assessee has taken health insurance policy on the health of his employees, whatever premium is paying on that policy is allowed as deduction, provided it is not paid in cash. Sir, what if it is paid in cash? No deduction. Okay. Next, bonus and commission paid by employer to employee is allowed as an expenses to the employer, provided he has not paid it as dividend or share of profit. Okay. Then interest on borrowed capital. If assessee has borrowed any capital which is used for business purpose, or if he has borrowed any loan which he is using for business purpose, whatever interest he is paying on that loan will be allowed as deduction. But if a loan is borrowed for the purpose of purchase of an asset, whatever interest is paid up to the date the asset is put to use will be capitalized as per section 43 subsection 1. After that, if there is any interest which is incurred, will be allowed here as per section 36. Or if there is any loan which is taken for a working capital purpose or for running the business, not to purchase any asset, whatever interest we pay for it will be allowed as deduction under section 36, guys, treating it as revenue. Okay. Then employer contribution to provident fund or any other fund which is for the benefit of employee will be allowed provided it is recognized and approved, as well as it should be for the benefit of employees. And all these three is also subject to 43B, guys. Means along with section 36, we should also check section 43B. Section 43B will tell it has list of few expenses where they're telling such expenses are allowed only if it is paid within the due date of filing the income tax return. If it is paid after the due date of filing the income tax return, it will be allowed, but in the next year. It will be allowed, but in the next year, guys. What is section 43B? We will learn it. But for this expenses, wherever I have given subject to 43B also, we need to check both, guys. Section 36 read with 43B. Okay, sir. Then next one. Employer contribution to NPS, that is National Pension Scheme, account of the employee. Deduction is allowed for employer contribution, but up to 14% of salary. And here what is salary means? Basic pay plus DA. DA condition attached. That is provided in terms of employment or forming part of retirement benefit. Okay. Next, employees contribution to welfare fund. This is employees. Please be careful. The above two was employer contribution. Employee contribution. Actually, it is not an expenses for the employer. He is just deducting it from employee's salary and he is depositing it. But first, when employee collect it from when employer collect it from employee, it will be deemed as an income for employer. And if you deposit that money within the due date of the respective fund, it will be allowed as an expenses to the employer. If not, automatically it will get taxed as income in the hands of employer. Means they are pushing the employer to deposit whatever money he has collected from employee as employee contribution. No, please deposit it within the due date of the respective fund, guys. Got it? Yes, I will try to explain this with an example. Look here. Yes. Ah. Now assume employer has collected employee contribution to provident fund in the month of August. First, treat it as an income, credit it to P&L account, treat it as the income for whom? Employer. And employer can claim it as an expenses provided he has deposited that amount within 15th of next month. Actually, for PF deposit, the due date is 15th of next week. So if whatever money is collected by employer from employee, if that is deposited within 15th of next month, then he can claim it as an expenses. If both of these are satisfied, then it will not have any effect, guys. Means ultimately it will have nil effect. Correct? Now both are equal. So credit is equal to debit. But what if by chance, if employer will fail to deposit this amount within the due date of the fund, so automatically this will be considered as income and the profit of the employer will increase and he will end up paying tax on it. Sir, what if you deposit on 16th or 20th of September? Still such expenses will not be allowed, guys. So please be careful for employees contribution to any welfare fund which is collected from employer. From whom? From employee. Such expenses will be allowed to employer only if it is deposited within the due date of the fund. And sir, what is the due date for each fund? Should we know it? No. Clear? They would have given some hint in the question. Accordingly, follow it. For PF, I have told you just for understanding purpose that 15th of next month is the due date, but you are not supposed to know the due date with respect to various funds, guys. Okay, sir. Next, bad debt written off in the books is allowed as deduction as per section 36, guys. Okay. Then expenses on family planning. If it is revenue in nature, it is allowed in full. Whereas if it is capital in nature, it will be allowed in 5 equal installment. And it is allowed only for corporate assessee, that is for companies. Then, if assessee's business is buying and selling securities or buying and selling commodities, then when you sell the securities or commodities, it will be taxable under the 8 Yes. In such case, whatever STT is paying for securities or CTT is paying for commodities is allowed as business expenditure. Is allowed as business expenditure. So in simple, if securities or commodities is a stock or inventory for an assessee, and when you sell it, the income will be taxable under the 8 and whatever STT or CTT you would have paid at the time of purchase and sale will be allowed as business expenditure. Sir, what if securities or commodities is a capital asset? Then we need to compute capital gains income, guys, not PGBP. But in such case, STT or CTT will not be allowed as expenditure. STT or CTT is not allowed as an expenditure under capital gains head. Got it? Yes. Next, section 37. So section 37 will not name any expenses, but it will tell whatever expenses is not covered from section 30 to 36, but it is incurred for business or profession of an assessee. And it is not personal in nature, it is not capital in nature, it is not illegal or immoral, and it is not disallowed later, as per section 40 and all. In such case, such expenditure can be claimed by the assessee as per section 37, guys, which we call it as general deduction. And all these conditions has to be satisfied. Even if one is missing, then deduction will not be allowed. And for this section, there is also an explanation. What is it? We will see. Any expenditure incurred by the assessee for any purpose, which is an offense or prohibited by law, is not allowed. Same way, to settle the proceedings initiated in relation to contravention under such law as may be notified by the central government is not deductible, guys. So if you have paid any amount to settle the proceedings which is initiated under any law because you have contravened that law, whatever amount you are paying to settle that will not be allowed as deduction. And which are those law has been notified by the central government? Which is it? It is an amendment, guys. Please be careful. I have given in the bracket SEBI Act, Securities Contract Regulation Act, Depositories Act, and Competition Act. These are the laws which has been notified by the central government. And if assessee has contravened any provision of this act which I have mentioned in the bracket, and to settle that if he has paid any amount, can he claim it as business expenditure? No, sorry, not allowed. Same way, whatever is the CSR expenditure incurred by the assessee as per section 135 of the Companies Act, it is not a business expenditure. It is not incurred for business purpose. It is just a contribution by an assessee towards the society. In such case, as it is not business expenditure, it is not allowed as per section 37 explanation, guys. Okay. I have given few notes here. Let us learn it. First one, premium paid on keyman insurance policy is allowed as business expenditure. Yes. Now, what is keyman insurance policy? It is a policy which is taken on key managerial personnel of the company, guys, like manager, director, or managing director, like that. And if the is very important person, key person for a company. So in that case, if policy is taken in their name and if premium is paid by the associate or a company, can they claim it as an expenditure? Yes. And if keyman insurance policy matures, there are three possibilities, guys. There are three possibilities. Sir, what is it? I will just cover it. Please pay attention. The money can be received either by the employer, employee, or family members. Sir, where is it taxable? Where is it taxable? So if the policy which is taken on the key man insurance, that is the key managerial person, we call it as key man insurance policy. If that matures, where is it taxable and for whom? Guys, when policy matures, if the person in whose name the policy is taken, if he is alive, and if that person receives the amount who is called employee, then it will be taxable in his hand under the head income from salary. Whereas if employer receives that amount, then for him it will be taxable under the head PGPP. For him means whom? For employer. Sir, what if by chance if employee has died, that is the key managerial person in whose name the key man insurance policy was taken, no? If that person is gone forever, oh bita. Okay. In that case, the family members or the nominee would be receiving the amount, and for them it will be taxable under the head income from other sources, guys. It will be taxable for them under the head income from other sources. All three cannot happen. Anyone, please be careful. Okay, accordingly, we need to check it. Okay, sir. Fine. So it has an impact for three heads, guys. Please be very careful with it. Next, if the payment for non-compliance of law is compensatory in nature, it is allowed as an expenditure. But if it is penal in nature, like penalty, it is not allowed. It is not allowed. And CSR expenditure, I already told, as it is not business related expenditure, it is not allowed, guys. Clear? And even in actually GST also, under section 17, subsection 5, which talks about block credit, they have clearly told if there is any inward supply with respect to CSR expenditure, whatever GST is paid on that inward supply, credit is not allowed. Credit is not allowed. For example, assume I have purchased a laptop and I have paid GST on it. Now I am distributing this laptop to government school children as a part of my CSR activity. Can I claim input tax credit on whatever GST I have paid on purchase of laptop? No, it is not allowed. As per section 17, subsection 5, guys. Okay. Fine. Sir, on this laptop, for income tax purpose, can I claim depreciation? No. Can I claim it as my business expenditure? No, sorry, you cannot. Fine. Any advertisement expenditure incurred in the souvenirs of a political party. So advertisement has been given to a particular political party in the souvenirs, then it is not allowed as business expenditure. But for this, sir, can deduction be claimed under section 80 GGB or GGC under the chapter 6A deductions? Yes, you can claim there, but not as business expenditure. Okay. Then the following expense. Actually, guys, these items are not specifically mentioned anywhere in the law, but we should know that the following expenses are not allowed for income tax purpose. So what are those, sir? The following expenses is not allowed while computing the income under this head, that is PGBP. Preference and equity dividend, any provisions created for any future liability or expenses, then transferred to any reserve. Guys, all this comes as appropriation of profit. So please pay first tax and do whatever you want with the remaining profit. That is what the Income Tax Act is telling. Then the last one, charitable and political contribution. So if an assessee who is having business or profession, if they do any charitable or political contribution, can they claim it as business expenditure? No, sorry, they cannot. But for this, deduction is allowed under Chapter 6A, guys. Chapter 6A. For charitable, deduction can be claimed under Section 80G, whereas for political, under Section 80GGB and GGC, guys. Okay, sir. Fine. Next, we will see the expenses which are disallowed under Section 40. Disallowed under Section 40. So for this, before we discuss this, we should have an idea about the TDS concept. I will just explain you using this chart. Okay, we will learn TDS as a separate concept later, but anyway, to whatever extent it is required now, I will explain, guys. Okay. Now, whenever payer is paying any expenses to the payee means the person who has earned it, he need to check, the payer has to check whether he has to deduct the TDS and at what rate. Assume the payer is paying 10 lakh to payee on which he is supposed to deduct 10% TDS, that is 1 lakh. So remaining 9 lakh he has to pay to the payee. So whatever 1 lakh he will deduct from payee, he has to deposit it to the government within 7th of next month. 7th of next month. And he should also file TDS quarterly returns in form 24Q, 26Q, 27Q. What are those and all? We will understand in TDS chapter, guys. Okay. And he should also issue a certificate of proof to the payee in form 16, 16AA or 16A, giving a information about what amount did he deduct TDS, under which section, on what day did he deposit it to the government. All this information he has to give it to the payee. And payee, while computing his income, he has to consider the gross figure, that is full 10 lakh. Whereas 1 lakh will be given as a credit for him while computing the tax liability. That is, from his final tax liability or total tax liability, we will reduce 1 lakh, which is allowed as a credit. Remaining amount he has to pay to the government before filing the income tax returns. Okay. So it is the responsibility of the payer to comply with all this provision. Sir, what if payer fails? What if he contravenes the TDS provisions? That is, if payer fails to deduct this 1 lakh, or he has deducted but he has put it for his pocket, he didn't remit it to the government. In that case, he cannot claim this 10 lakh as an expenditure. Because obviously for payer, this is an expenditure. No, 10 lakh is an expenditure. For payer, it is an income. Whereas for payer, it is an expenses. So, if payer has not is not following the TDS provision, or if he has contravened TDS provisions, then such 10 lakh will not be allowed as expenditure. Sir, how much will be disallowed? Depends on who is the payee. If payee is outside India, or if he is a non-resident or foreign company in India, then as per section 40A1, 100% of the expenditure will be disallowed. That means entire 10 lakh will be disallowed, guys. Sir, what if it is deducted but remitted later? And as per section 40A1, the time given is not the due date of TDS. They are giving the time till the due date of filing the returns as per section 139 subsection 1, which I just now explained. There are actually 3 dates. Any one date will be applicable to the assessee. For PGBP purpose, let us consider it as 31st October. 31st October. So, if TDS is deducted but not remitted to the government within the due date, it is disallowed in the current year. But if it is remitted after the due date, it will be allowed. Whatever it is disallowed now will be allowed in next year. Or else, sir, the payer didn't deduct TDS at all, but he deducted after the due date of filing the income tax return and he remitted it to the government. In that case also, whatever is disallowed in the current year will be allowed in the next year. Is that clear? Yes. So in this case, how much will be the disallowance? 100%. Whereas if the payee is a resident in India, only 30% will be disallowed. That is 30% of 10 lakh, which comes to 3 lakh, will be disallowed. Is that clear, guys? Yes. And please be careful. the time limit to deposit TDS is 7th of next month. Whereas under section 40A1 and 1A, which we are learning now, the deadline given is not this one. They have given the extended time till when? Till the due date of filing the returns as per section 139 subsection 1. If the payer has not deducted TDS or else deducted but not remitted to the government within this date, then as per section 40A1, 100% of the expenditure will be disallowed, or as per section 40A1A, 30% of the expenditure will be disallowed, depending upon who is the payee. Who is the payee, guys? Clear? Sir, what if it is made good after the due date? Then whatever is disallowed now will be allowed in the next year, guys. So, for example, here 3 lakh is disallowed, no? Assume TDS is deducted and remitted after the due date of filing the returns. Then 3 lakh, whatever was disallowed in the current year, will be allowed in the next year. Not entire 10 lakh, because 7 lakh is already claimed. Only 3 lakh was disallowed. So whatever was disallowed will be allowed later. Got it? Yes, sir. So you can just see this point. I will quickly read it. TDS not deducted or deduct TDS but not paid the same on or before the due date of filing the income tax return under section 139 subsection 1. So please be careful. Here they are not referring to the TDS due date. They are referring to the due date of filing the returns. Oh. As per section 40A1, any sum payable outside India or to a non-resident or a foreign company within India, 100% of such expenditure, not TDS amount. Please be careful. 100% of what should I take? Sir, here 100% of 1 lakh, 100% of 10 lakh, 100% of expenditure, which is 10 lakh, is disallowed. Okay. Next, as per section 40A1A, the expenses payable to resident in India, 30% will be disallowed in the previous year. Okay. If the TDS has been deducted or deposited after the due date of filing the returns, whatever it is disallowed in the current year will be allowed in the next year. Okay, sir. And there is one more connecting point here, that is as per section 48.3, but here it is very strict. What is it? We will see. 48.3, third point. Salaries payable outside India or to a non-resident, okay, outside India or to a non-resident anywhere. If TDS has not been deducted, or else TDS is deducted but not paid to the government within the due date of TDS, not the due date of returns, due date of TDS, that is 7th of next month, then such payment shall not be allowed permanently. It will be disallowed permanently. For example, now assume I have paid a salary to a non-resident without deducting TDS. So within 7th of next month, I was supposed to deduct TDS and I was supposed to deposit it, but I have not done it. But later I realized my mistake, so I deducted and deposited on 10th of next month, which is after the 7th. So even if I deposit one day later after the due date of TDS, the expenses is disallowed permanently. I cannot even claim it subsequently, guys. So this is very strict. Please be careful. Clear? So salary paid to non-resident or outside India is covered here. Any other payment paid outside India or to a non-resident will be covered here as 40A1. Got it? Yes, sir. Then second point. Just a minute. Yes, second point. As per section 48.2, income tax or foreign income tax is not allowed as deduction, guys. Even anything part of income tax like advance tax, surcharge, cess, it will not be allowed. Even provision for income tax will not be allowed, guys. Clear? Because we are computing the business income on which we are supposed to pay tax. Even before calculating the business income, can I claim that expenses? No, guys. Even if you have paid any tax in foreign country also, you cannot claim such expenditure for income tax purpose. Okay. Then section 40B. Okay. This is important, guys. Section 40B is applicable only for partnership firm. Whatever interest the partnership firm is paying to the partner, that is interest on capital or interest on loan, will be allowed maximum 12% per annum, provided it is mentioned in the deed. Or in the deed, if that it is given only 10%, only 10% will be allowed. The rate as per the deed are 12% maximum. Sir, in the deed itself, it is given 20%, sir. Still, maximum allowed is 12%. Clear? Sir, deed is silent about the interest, sir. Then no deduction is allowed for interest, guys. No deduction is allowed for interest. Oh. Next, salary, bonus, commission, or remuneration paid to the partners. Guys, it is allowed as an expenses for the firm, provided it is paid to the working partner and it is mentioned in the deed. What is the amount of remuneration or the manner in which the remuneration has to be calculated is mentioned in the deed. Only then it will be allowed. Sir, what if salary is paid to the sleeping partner? It is not allowed as an expenses. Sir, what if salary is not mentioned in the deed? It will not be allowed as an expenses. So, okay. Assuming all this condition is satisfied, how much remuneration paid to partners is allowed, sir? Interest part we already discussed, that is separate. Whereas anything paid in the form of salary, bonus, commission, or remuneration, for that, we need to take actual remuneration or the limit as per section 40B. Whichever is lower will be allowed as deduction under section 40B, guys. Okay. So what is the limit as per section 40B is on the first 6 lakh book profit or in case of book loss, we need to take 3 lakh or 90% of book profit, whichever is higher. On over and above 6 lakh book profit, we need to take 6%, 60%, guys. 60%. Sir, first of all, what is book profit, sir? Book profit means a profit of the firm after all the expenses as per Income Tax Act. Even after claiming interest, whatever is left is called book profit. But it should be before remuneration because remuneration we are calculating now. So I repeat, book profit is a profit of a firm as per Income Tax Act after all the expenses but before remuneration. So from book profit, if I reduce the remuneration as per 40B, that is actual remuneration or limit as per 40B, we will get taxable business income of the firm, guys. Is that clear? Yes. I will just discuss one question on this. Okay. So come to the question bank. In that, yeah. Question number 7. Question number 7, guys. Rao and Jane, a partnership firm consisting of two partners, reports a net profit of 17 lakh before, okay, before deduction of the following items. Means the following items has not been deducted. It is not yet debited. Okay, what are those? Salary of 20,000 each per month payable to two working partners of a firm as authorized by the deed. Okay, it is allowed, but subject to the limit. Depreciation on plant and machinery under section 32 allowed 150. Interest on capital at 15% per annum as per partnership deed. The amount of capital eligible for interest is 5 lakh. So as per deed, the interest is 15%, but as per section 40B, maximum allowed is how much? 12%. Okay, but please be careful. Any of this expenditure is not yet debited. So, how do we calculate the book profit and permissible remuneration? We will see. So, take the net profit as given in the question, 17 lakh, and from that reduce depreciation under section 32. Then interest on capital, how much is allowed as per section 40B? Only 12%. Reduce that. 5 lakh into 12%. Okay. So we get book profit of the firm. Sir, what about salary? Should we deduct it? No, no. Because book profit of a firm means the profit of the firm after all expenses but before remuneration. But before remuneration. So 1490 I need to take. So book profit is 1490. So let us calculate what is the remuneration permissible as per section 40B, guys. Actual remuneration 20,000 into 12 months into 2. Okay. 4 lakh 80,000. Fine. Then that is for both the partners put together. You need to take it. Then limit under section 40B. First, on the first 6 lakh book profit, 6 lakh into 90%, 5 lakh 40. Sir, there 3 lakh was given, no sir. Their minimum is 3 lakh, guys. If by chance, if this 90% of book profit or in case of book loss, we can at least take 3 lakh. Clear? That is bare minimum. Okay. Fine. So 6 lakh into 90%, 540. On the remaining, remaining is how much, people? So 1490 minus 6 lakh, we will get whatever amount we get into 60%. So 5 lakh 34. So the limit as per 40B is 10 lakh 74,000. Compare both of this, whichever is lower is allowed. 480, which is actual remuneration. Clear? Sir, what if by chance this is like 280? Then only 280 will be allowed. 280 will be allowed. Actually, 280 cannot come because minimum 3 lakh will be there here. So let me assume 3 lakh only. The partnership firm has a loss. So limit as per 40B, we are getting 3 lakh. So 4 lakh 80 or 3 lakh, whichever is lower, 3 lakh will be allowed. Okay. And taxable income of a firm is 10 lakh 10,000. 10 lakh 10,000. Okay. And what if by chance, sir, in this question, what if it was instead of before, it is after? That means the following expenses is already debited, sir. So this profit is after debiting the following items. In such case, should we again deduct depreciation? No, sir. It is already deducted. It is allowed, so we will not do it. And 15% interest is already debited, sir. So what should I do? Now I need to add back 3%. What is disallowed? No, that I need to add back. That I need to add back. And the salary is also already debited, right? So what should I do? Add it back. Add it here. Whatever is the actual remuneration, add it. As it is already debited, please add it. Now you will get book profit. From there, the calculation remains same. From there, the calculation remains same. I have just explained the answer. What if this is after instead of before this? That means this three expenditure would have already been debited, and the profit whatever is given in the question is after debiting these items. So accordingly, adjust it. Got it? Yes. And please be careful. This 3 lakh is minimum. So minimum 3 lakh will be allowed as remuneration. And we already discussed, guys, whatever is allowed as an expenses for the firm, the same amount will be taxable in the hands of partner under the head PGBP. We discussed that provision already. Okay, sir. Fine. Next, expenses restricted as per section 40A, capital A. What are those? As per section 40A2, A2, look here. Excessive or unreasonable payments made to any specified person, that is relative or associated concern, will be disallowed. Only that excess part is disallowed, guys. Now assume I paid for my brother 1 lakh rupees, but to the extent of 30,000 it is unreasonable. So how much will be disallowed? Only 30,000. So that means remaining 70,000 will be allowed? Yes, it will be allowed. Okay. Sir, how do we decide whether it is reasonable or not reasonable? How much is excessive and all? It has to be decided based on arm's length price, guys. But anyway, you will not decide it in the exam hall. Anything with respect to this will be given in the question itself directly. Accordingly, treat it, guys. Next, as per section 48(3), if there is any cash payment made to a single person in a single day more than 10,000, then it is completely disallowed. If it is 10,000 or less, it is allowed. If it is more than 10,000, entire amount is disallowed, guys. Please be careful. For example, I paid to you today 20,000 in cash. Can I claim it as business expenditure? No, I cannot. And what is disallowed here is revenue expenditure. Sir, what if it is capital expenditure? Guys, if capital expenditure is paid in cash for a single person in single day more than 10,000, then as per section 43 subsection 1, you cannot include it in the actual cost calculation. You have to ignore that money. Accordingly, you cannot claim depreciation on it. Yeah. So what is covered here is only revenue expenditure, guys. Clear? Now you guys tell me. Employer paid an health insurance premium of 3,000 in cash. Is it allowed? Is it allowed? Hello? Is it allowed? No. Because as per section 36 itself, they are telling health insurance premium should be paid in any mode other than cash. So if any amount, whether it is 1,000, 2,000, 10,000, it is disallowed if it is paid in cash as per section 36 itself. So what is disallowed under section 48(3) is if it has already crossed all other section and if it has come here, they will tell stop. We will not allow it. We will not allow it. Okay. Whereas if the payment is made to plying, hiring, leasing of goods carriages, then the amount specified is not 10,000. It would be 35,000. Normally it is 10,000, but if it is for any goods carriage and all, 35,000, guys. Clear? And this restriction will not be applicable in case if the payment is made in rural area or if the payment is made to RBI or any government or in any area where there is no banking facility. Okay, so these are like exceptions for section 40A(3), guys. Okay, then as per section 40A(7), if employer has created any provision for the payment of gratuity to an employee in the future, when he has created the provision, deduction is not allowed. But in the year in which payment of gratuity is made, entire amount whatever is paid will be allowed as deduction. Will be allowed as deduction, because many a times what happens, no, gratuity is a lump sum amount. So it will be difficult for the employer to arrange this money all of the sudden. So every year a part of the profit he will set aside as a provision for gratuity. Can he claim it as business expenditure? No. But in the year in which he pay the amount, whatever amount of gratuity is paying, you can claim it as full deduction, guys. Full deduction. Okay, fine. Next, section 43A, which talks about change in the rate of exchange. So, if an assessee has purchased a depreciable asset which you will use for business purpose from a country outside India on credit basis, or he has purchased it anywhere but he has borrowed a loan for purchase of that asset in foreign currency. In that case, at the time of making the payment, due to currency fluctuation or exchange rate fluctuation, if he has any exchange loss or exchange gain, he can adjust it against the actual cost of an asset, guys. Actual cost of an asset. So that is, if he has exchange loss at the time of making the payment, he can add that exchange loss to the cost of an asset, or if he has exchange gain, he can deduct it from the cost of an asset, and accordingly he can claim the depreciation on the revised cost. And please be careful, this adjustment only at the time of making the payment, not at the end of the financial year, because in your accounts and all you would have learned on 31st March also, on the reporting date we will make necessary adjustment depending upon the exchange rate. No, no, no. Here they are telling on the date of making the payment, check whether there is any exchange loss or exchange gain. If yes, accordingly change the cost of the asset, guys. So let me try to explain this with an example. Just a minute. Yeah. So assume, guys, I had purchased an asset for $1 lakh at 75 rupees per dollar when I was purchasing it. So I would have recorded the actual cost of the asset at how much? 1 lakh into 75 rupees. Okay. And assume I have purchased this asset on credit basis or by borrowing the loan. Okay. So I have initially recorded the asset at 75 lakh when I purchased it and I started using it. But I am not paid for it fully. Oh. Now assume I paid $10,000 out of it when the exchange rate was 77 rupees. So in order to purchase $10,000, for each and every dollar I have paid 77 rupees. That means when I purchased, what was the exchange rate? 75 rupees. So there is an exchange loss of 2 rupees per dollar. So 2 rupees into $10,000 will be 20,000 exchange loss. So what should I do? Add it to the cost of an asset. Add it to the cost of an asset. Assume I am making a second payment of again $10,000 when exchange rate is 80 rupees. So what is the exchange loss now? 5 rupees per dollar into $10,000. So what is the total exchange loss? 50,000. Even add that. So at the time of making this payment, add 50,000 to the cost of the asset. On that day, the cost of the asset might not be same 75 lakh because till then I would have claimed depreciation. No? Yes. So on the date of making this payment, whatever is the cost of the asset, for that we need to add 50,000. Then assume third payment I am making when the exchange rate is 70 rupees. I am making a payment of $10,000. So that means the exchange rate has come down. So there will be a gain of how much? 5 rupees per dollar. I need to compare this with this. This is the exchange rate at the time of purchase, guys. Okay. So there is a gain of 5 rupees into $10,000 will give us a gain of how much? 50,000. So what should I do? Deduct it from the actual cost of the asset. So whatever might be the cost of an asset when I'm making this payment, from that I need to deduct 50,000, guys. Got it? Yes, sir. Chalo, let us go back. Yeah. So 43A is done. Next 43B, one of the important section, people. Okay. Now 43B includes various expenses which is allowed as an expenses only if it is paid within the due date of filing the income tax returns. What is the due date of filing the income tax returns? We just now saw. Okay, that is from assessment procedure chapter. Okay, sir. Now for income tax purpose or for PGBP purpose, let us see, we cannot consider all the three dates. No. So I will take 31st October as the due date for an assessee who has a business income. Okay. So if the following expenses is not paid within the due date of filing the income tax return, then this expenditure will not be allowed in the current year. Sir, what if it is paid after the due date? It will be allowed, but in the next year. So what is it? Quickly we will see. As per section 43B, deduction will be allowed of the following expenses only on the payment basis. Okay. That is only if the payments are actually made, not within 31st March. Payment has to be made within the due date of filing the income tax returns as per section 139 subsection 1. Okay. So what are the expenses covered here? Not every expenses is covered here, guys. Only few. What are those? taxes, duties, cess or fees payable under any law but except income tax law. Because anything you pay under income tax law, including surcharge, cess and all, is anyway not allowed as an expenses. So here whatever taxes is covered is other than income tax law, like municipal tax paid for the property owned by the assessee for business purpose or GST payment, those things are covered here. Okay. Next, bonus and commission to employees, interest in respect of term loans or advances borrowed from specified institution like financial institution or banks, then leave encashment paid to employees, then amount payable to Indian Railways for use of railway assets, whatever we pay in the form of rent or hire charges. Then employer contribution to PF or superannuation fund or any other fund for the welfare of employees. If the following payments are made within the due date, claim it in the current year. If not, if it is made after the due date, you can claim it in the subsequent year. You can claim it in the subsequent year, guys. So, just a minute. I will explain this with an example here. Yeah. I just drawn a timeline here. Assume, guys, whatever is covered under section 43B, no? That is from clause A to G. Clause A to G. That is this items. Okay. Yes. So if this expenses are relating to previous year 25-26, that is this expenses are incurred any time between 1st April to 31st March 2026, then this expenses you can claim it in the current year provided you have paid it within the due date of filing the returns. So let us consider the due date for filing the returns is 31st October of assessment year. So any expenses which is covered under section 43B from clause A to G, if it is paid within this date, you can claim it in the current year. Sir, what if it is paid after this date I have given here? You can claim it as an expenses, but in the next year. In the current year, it will be disallowed, whereas in the next year, it will be allowed, guys. Got it? Yes. And please be careful, guys. What is covered here is employer contribution to PF or any other superannuation fund, not employee contribution. Okay, so I will just try to explain this little detail. Guys, employees contribution, the provision was covered in section 36 itself. We already seen it. Okay. Whereas for employer contribution, there are different provisions applicable. I have tried to cover everything here. For employer contribution to PF or any other welfare fund for the benefit of employees, all these conditions has to be satisfied. Only then employer can claim it as an expenses, guys. What are those, sir? One by one. As per section 36(1), 4 and 5, they are telling whatever fund for which the employer is contributing, it should be approved or recognized and it should be for the benefit of employees. Okay. And section 40A(4) is telling the employer should have made the arrangement to deduct TDS at the time when employee is withdrawing it. That is from this fund. When employee is withdrawing the amount, if it is taxable in the hands of employee, the employer should have made an arrangement with the fund to deduct TDS. If he has not made that arrangement, then employer contribution is not allowed. Okay. Then as per section 40A 9, 10 and 11, it is telling it should be within the limit and it should be for approved fund. And just now whatever we covered, section 43B, they are telling the employer contribution has to be deposited within the due date of filing the income tax returns. That is as per section 139 subsection 1. Only then employer can claim this deduction. Please be careful for employer contribution. They are asking to deposit it within the due date of filing the income tax return. Whereas employee contribution, they are asking to deposit it within the due date of the respective fund. Okay, because for this especially the rules is strict. You cannot play around with the employee money. So if you are holding it for a longer period, then such amount will not be allowed as an expenses. For whom? For employers. Got it? Yes. Next, this is important. Guys, this is a part of section 43B itself, but separate provision is applicable. That is why I have given it separately here. Oh, sir, what is it? Please pay attention. Please pay attention. Now assume, guys, I have purchased any goods or services from a micro or small enterprise and I am not supposed to make payment to them. Yes. Whatever payment I am making to them, if I am making it within the due date mentioned in section 15 of MSMED Act. MSMED Act means Micro, Small, Medium Enterprise Development Act. Okay, yes. So, if I am making the payment within the due date as mentioned in section 15 of MSMED Act, I can claim that expenditure on accrual basis in the year of accrual. But if I pay it after the due date as mentioned in section 15 of MSMED Act, I can still claim it as deduction, but in the year of payment. In the year of payment. I repeat. Whenever I am supposed to make any payment to micro or small enterprise for the goods purchased or for the services availed, if I make it within the due date as mentioned in MSMED Act, I can claim it on accrual basis. If I make the payment after the due date, then I can claim it on payment basis. That is in the year of payment. Got it? Yes, sir. So what is the provision? We will see. Some payable, even this is a part of section 43B itself, but the provision is different. It is different. The timeline and all is different. That is why we are covering it separately, guys. So what is it? Some payable by the associate to micro and small enterprise for the supply of goods or services beyond the time limit specified in section 15 of MSMED Act. MSME means micro, small and medium enterprise. Actually, even medium is covered here. But in section 43B, they are not covering the payment made to medium enterprise. They are covering only the payments made to micro or small enterprise. This provision has been introduced in order to protect their interest, guys, because many big players, they will not make payment to the small people within the time. They will make them to wait months together. So that is why as a payer, if you make the payment within the due date, you claim it on accrual basis. If not, you claim it on payment basis. That is what section 43B is telling. Okay. So what is section 15 of MSMED Act is telling us? First check, is there a written agreement between the assessee and micro or small enterprise? If yes, then payment has to be made within the date mentioned in the agreement or within 45 days of accepting the goods or services, whichever is earlier. If there is a written agreement between assessee and the enterprise. No, sir, there is no written agreement. In that case, payment has to be made within 15 days of accepting the goods or services, guys. So if payment is made within this time, it is allowed as expenses on accrual basis to the payer. If not, if the payment is made after this due date means, it will be allowed in the year of payment, guys. Now, I have given here. However, if the sum is not paid within the time limit specified above, the deduction for such expenses would be allowed in the previous year in which the payment is actually paid. Okay. So here, whatever payments are made to only micro and small enterprise is covered. Now, when do we know or how do we consider whether an enterprise is micro or small? It is given here, guys. And it has undergone an amendment. So please be attentive now. Manufacturing enterprises and enterprises rendering services. So if it is a micro enterprise, their investment in plant and machinery or equipment will be less than or equal to 2.5 crore and turnover is less than or equal to 10 crore. Both the condition has to be satisfied. Oh. And small enterprise, their investment in plant and machinery or equipment will be less than or equal to 25 crore and their turnover will be less than or equal to 100 crore. Got it? Yes. Both the condition has to be satisfied. And if you remember micro, into 10 will be small guys. Into 10 will be for small enterprise. And this limits, whatever is given here, no, it has undergone a change. It is an amended figure, guys. Please be very careful with it. Okay, sir. Fine. So this part is very important, guys. Okay. They might be testing on this. I will try to cover an illustration on this from the provision book. Just a minute. I will open it. Yes. I have illustration on this provision. Let us quickly go through it. X Limited purchases a raw material on credit from Y Limited. Value of invoice is 6,40,000. Date of invoice is 1st February and date of acceptance of goods is 1st February. Okay. Y Limited is a manufacturing company and its investment in plant and machinery is 3 crore. Okay. Generally, the payment is made by X Limited within 30 days. However, there is no written agreement about the time of payment. Guys, when there is no written agreement between the enterprise, that is the assessee and enterprise, then the payment has to be made within 15 days of accepting the goods or services. So, goods is accepted on 1st February. So, within 15 days means on or before 16th February. On or before 16th February. Yes, sir. So, observe. So, if the payment is made on 28th February, is section 43B applicable? Yes, because the payment is made after the due date. So expenses will be allowed on payment basis. So when the payment is made in the financial year 25-26, it will be allowed. Anyway, it is made within the end of the financial year, it will be allowed in the same year. Okay. Next, what if the payment is made on 31st March 2026? So it is not made within the due date. So it will be allowed on payment basis. But in which year? 25-26, because the payment is made on the last day of the previous year. Sir, what if payment is made on 10th April? That is in the next year. So payment is not made within the due date. So it will be allowed on payment basis. So which is the year in which payment is made? The previous year 26-27. So it will be allowed in the year 26-27, guys. In these two cases, payment is actually not made within due date, but it is paid within 31st March. So can it be claimed as an expenses in the same year? Yes, but on payment basis. But on payment basis. Okay. Chalo, one more illustration. Z Limited purchases goods, invoice value is 11,20,000 on credit from A Limited, a micro or small enterprise as per MSMED Act. Date of purchase is March 2nd, 2026 as per written agreement with A. Z Limited as to make the payment on or before 30th April 2026. So when there is a written agreement between the associate and the enterprise, then the payment has to be made as per the agreement or maximum 45 days from the date of accepting the goods or services, whichever is earlier, guys. Okay. So the payment is made in installment on various dates. We will see. Date of accepting the goods is 2nd March. So calculate 45 days from 2nd March. It comes to how much? April 16th. Whereas the due date as per the agreement is April 30th. So April 16th or April 30th, whichever is earlier, guys. April 16th. So as per MSMED Act, the due date for payment is April 16th. And the payment is made in installment. Let us see one by one. First payment 1 lakh is paid on March 30th. It is paid within the due date. So it is allowed on what basis? Accrual basis. So 43B is not applicable. So these expenses are accrued on which year? 25-26. It will be allowed. Okay. Next. 2 lakh is paid on April 6th, again within the due date. So it is allowed on accrual basis. So in the year 25-26, that is the year of accrual. Okay. Next payment is made on April 15th, 4 lakh. Again, it is paid within the due date. So it is allowed on accrual basis in the year of accrual, 25-26. Last payment. This is important. Last payment is made on May 6th, 2026, 4,20,000. And is it made within the due date? No, it is not made within the due date. So is section 43B applicable now? Yes. So expenses is allowed on payment basis. So in which year the payment is made? In the year 26-27. So it is allowed as an expenses in the year 26-27. How much? 4,20,000. 4,20,000. 420. No, I didn't call you. I was telling about the amount. Yes. Next. Deemed profits under section 41. So deemed profit is covered under 5 subsections, guys. What are those? One by one we will see. Section 41 enumerates items of notional income which are deemed to be the income from business or profession. The items of deemed profits are enlisted below. What are those? Subsection 1. Subsection 1 will tell if assessee has claimed any expenses or loss or liability in the past and the profit of that particular year has come down. Now, if it has been recovered back by the assessee or if that payment is cancelled, then in the year in which he has recovered or payment is cancelled, it will be taxable as business income, guys, as per section 41 subsection 1. Then balancing charge part, we already covered it along with the depreciation portion. Then sale of scientific research, that is subsection 3 also we already covered, guys. Then bad debt recovered. Bad debt recovered is not covered in subsection 1. Any other loss is covered here, whereas bad debt, subsection 4. Assume in the past I had already claimed some bad debt on credit sales. But now that person came in search of me and he paid me the amount in the current year. Will it be taxable as business income? Yes. Bad debt recovered will be taxable in the year in which it is recovered. But in the past, if any amount was disallowed, that is, it was not allowed to be claimed. So when bad debt is recovered, we need to reduce whatever was disallowed in the past. Sir, how will I know this? It will be mentioned in the question, guys. So when bad debt is recovered, if any amount was disallowed in the year, that is in the past, we will reduce it, remaining will be taxable. Sir, what if question is silent about this? Then whatever is recovered is taxable, guys. Is taxable. Okay, sir. Then deemed profits from a defunct business. Defunct business means which is closed down, which is ceased to exist now. can be set off against brought forward losses of such business even after the expiry of 8 years. Now assume guys, I was carrying on some business in the past and I had huge loss from it. So I shut it down. I closed it. Yes. Now from that business, I am recovering any of this amount, which is taxable under section 41. Even though I have closed down, is it still taxable? Yes. Assume as per section 41 subsection 1, I had recovered some loss or I have recovered some bad debt in the current year of the business which I was carrying on long back. In that case, whatever amount I have recovered from the business which I was carrying on long back, if I had any loss from that business, can I adjust that loss against this deemed income? Yes. They're telling you can adjust it. Even though for actually maximum time period allowed for adjusting the business loss is 8 years. Even though 8-year period is over, still you can adjust that loss. If at all, if you have it, you can adjust it against any of the deemed income covered under section 41, guys. Got it? Yes, sir. So this is the provisions with respect to the PGBP. Sir, how do we calculate the income, or how do we calculate the income from business or profession? And while calculating it, what is allowed or what is disallowed? And in my question bank, in question number 8, I have given the list of expenses, guys. We need to identify whether it is allowed or disallowed and as per which section. So I have given good number of items here, almost 30 I expenses I have given, where I have tried to cover all the important items, guys. So I want you guys to go through it. Anyway, I already given the solution in the last column, whether it is allowed or disallowed as per which section. Please go through this question, guys, along with the answer. Yes. So I will discuss one question with respect to computation of income under the head PGBP. That is question number 9. Quickly come to this. From the following information, find out the taxable business income for assessment year 26-27. Okay, they have already given the profit and loss account of AB Limited. Okay, on the credit side, we will see sales, commission, interest on loan given to directors, interest on FD, rental income, sale of building, sale of shares is given. Guys, sales is anyway taxable as business income, whereas commission, it is like it can be taxable either under the PGBP or other sources. But let us consider, if question is silent, can I consider it as business income? Yes. Whereas the other items are taxable but not under the head PGBP. They're taxable under other heads. For example, interest on loan and interest on FD will be taxable under the head other sources, whereas rental income will be taxable under the head house property, whereas sale of building and sale of shares is taxable under the head capital gains. But as these items are credited here, the profit would have gone up, right? Yes. So what should I do? When I take net profit as a base, I need to deduct all these items. Whatever incomes are credited here but not taxable under the PGBP, I need to deduct it. Okay. Coming to the debit side, salary for employees, office boy salary is allowed, audit fee allowed, income tax not allowed. So we need to add it back. Okay. Then municipal tax for residential house. Guys, this can be claimed as an expenses under the head house property. From gross annual value, we can deduct it, but it is not allowed under the head PGBP. Then depreciation given in P&L account will always be as per books of accounts, guys. Whereas we need to compute depreciation as per section 32, which normally will be given in the adjustment, or else they would have given the asset details in the question, for which we need to apply the respective rate and calculate the amount of depreciation. Okay. Then interest on loan from bank. Total is 35,000. Paid 20,000 on 28th February 2026 within the due date of filing the returns allowed. Whereas 15,000 is paid on 1st January 2027. This amount is not paid within the due date of filing the returns, guys. So 15,000 will be disallowed as per section 43B, as interest is one of the item covered under section 43B. Next, bad debt written off is allowed as deduction, whereas goodwill written off not allowed. Advance tax paid, as it is a part of income tax, not allowed. GST paid is allowed, whereas dividend paid, it is an appropriation of profit, hence not allowed as an expenses. Okay, they have given adjustments here. Depreciation as per Income Tax Act is 52, it is allowed. Office by salary is paid in cash on 30th November 2025. So single payment made to a single person in a single day. How much is that office boy salary? 54,000. So more than 10,000, guys. So as per section 48.3, it is disallowed. It is disallowed. When I saw here, it looked like it is allowed, but in the adjustment they have given some masala. As per that, it is disallowed, guys. Oh, they have also mentioned building, shares and agriculture land was owned in the name of company. Okay. So there is an agriculture income also. Okay, here also there are few items. Okay, bad debt recovered. Is it taxable as business income? Yes. Agriculture income, it is exempt under section 10(1). As it is already credited. So what should I do? Deduct it. Then dividend from domestic company will be taxable under the head other sources, guys. So we need to deduct it. Oh. So take net profit as the base and whatever income is already credited to P&L account but not taxable as business income. What should we do with it? We need to deduct all that. And even depreciation, whatever is given in the adjustment as per section 32, allow it. Allow it as an expenses. Same way, whatever expenses is already debited on the debit side, but it is not allowed as per Income Tax Act, add back all those items, including depreciation, because depreciation given in the P&L account will always be as per accounts tax. So all this expenses has to be added back because it is disallowed. So finally, we will derive taxable business income, which is 5,82,000. And to the extent possible, try to give the note, guys. And if you are running short of time, if you are not able to give note, at least mention like this in the bracket, like how I have given here. Got it? Yes. So I have tried to cover one question on this computation of taxable business income, guys. No worries. I will upload a separate video on the questions which I will discuss on calculation of total income and tax liability. I will try to cover maximum question and upload it as a separate video. And I want you guys to watch it without fail and practice all those questions, because I will try to cover all the important questions which was asked in the past exams, RTP, including the questions which was asked under compulsory sections, guys. So you cannot afford to miss that video. Now let us go back to revising the provision. Guys, till now we are done with the first part of PGBP head, where we saw what expenses is allowed or what expenses is not allowed while computing the PGBP income. Now, in the second part, we will see who should maintain the books of account, who should get it audited, and there are three presumptive schemes covered in your syllabus. What are those? And how do we compute the income under that particular presumptive scheme? Yes, one by one we will see. First, section 44 AA, which talks about books of accounts. When a person has to maintain books of accounts. Okay. First, they have covered specified person. Who is specified person is given in rule 6F. Let us learn that. Rule 6F, specified person includes person carrying on the profession of legal, that is lawyers, or medical, that is doctors, or engineering or architectural or the accountancy, that is chartered accountants, or technical consultancy or interior decoration or film artist or company secretary, CS are also covered here, and information technology professionals. So if you are a person who is covered here as per rule 6F, when should you maintain the books of account? If your gross receipts from your profession is more than 1,50,000 in all the 3 years immediately preceding the current year. So we are checking whether should we maintain the books of accounts for the current previous year. For that, we need to go back to the last 3 years and check what is the gross receipts from profession. If gross receipts from profession is more than 1,50,000 for all the 3 years, then in the current year, books of accounts has to be maintained. So I have given you can see for specified person. Should we maintain books of accounts in the current year or not? Depends on what is the gross receipts for the last 3 years. In each year, if gross receipt is more than 1.5 lakh, please be careful. 1.5 lakh limit is for each year, not for all 3 years put together. In each year, the gross receipt should be more than 1.5 lakh. Only then in the current year, the books of accounts is applicable, guys. Okay, sir. Fine. What about others? Non-specified person is divided into two categories. First, individual and HUF. For individual and HUF, if the income from business or profession is more than 2,50,000 or total sales or turnover or gross receipts from business or profession is more than 25 lakh. Guys, sales, turnover, gross receipts, everything is one and the same. Don't get confused. So if any of this has crossed in any 1 year out of the last 3 years, then such individual or HUF has to maintain books of accounts in the current year, guys. In the current year. Okay. Sir, what about other assessee? Other assessee means who is non-specified person, not an individual or HUF, like company, partnership firm will fall here. If the income from business or profession is more than 1,20,000 or if the total sales or turnover or gross receipt from business or profession is more than 10 lakh in any 1 year out of the last 3 years, from the current year, they have to maintain books of accounts. And once you start maintaining the books of accounts, you have to continue maintaining it even for subsequent years. Okay. I mentioned here, you can see, for a non-specified person who is an individual or HUF, should they maintain books of accounts or not in the current year? Depends on if their gross receipts in any of this year, not in all three, in any of these 3 years is more than 25 lakh, or if income in any of this year is more than 2 lakh 50,000. If any one of this is crossed, we need to maintain books of accounts in the current year. Sir, what about for others like company, partnership, firm and all? Whether they have to maintain books of accounts or not in the current year depends on what is their gross receipts in the last 3 years or income. If gross receipt is more than 10 lakh or income is more than 1.2 lakh in any one of this year, they have to maintain books of accounts in the current year. Got it? Yes, sir. So please be careful. Here it is like all 3 years condition has to be satisfied. Whereas here, any one out of the 3 years. Okay, sir. Fine. Sir, what if I am a person who is starting a business or profession for the first time during the previous year? It is not a good provision. Loose connection is there, but still, if I am a person who is starting a business or profession for the first time in the current year, if my turnover or income is likely to cross the above limits, whatever is applicable for me by the end of the year, that is till 31st March of the previous year, I have to maintain the books of accounts from day one. Sir, how will I know by the end of the year what will be my turnover or income? Very less chances. Even though I might estimate it, but it might not be accurate. So, if my income or gross receipt is likely to exceed the limit applicable for me, then I have to maintain the books of accounts from day one itself. Okay, sir. Fine. So, second and third point, I will cover it later, guys. It is connected to presumptive schemes. Yeah. Sir, how long should we maintain the books of accounts? It has to be maintained for 6 years from the end of assessment year, guys. Effectively for 8 years. Sir, how is it, sir? I will just explain. Listen here. Assume, guys, I am maintaining books of accounts for previous year 25-26. So what is the assessment year 26-27? So what is the end of assessment year 31st March 2027? From here, I need to maintain it for 6 years. That is till 31st March 2033. Yes. So effectively, in the law, they have told 6 years from the end of assessment year. So effectively, I am maintaining it for how many years? For this year only, I am maintaining the books. Anyway, I have to keep it plus one assessment year plus 6 years from that end. So effectively 8 years, guys. But don't worry, this is what I am mentioning. In the law, what they have told is 6 years from the end of assessment year. Okay, sir. Fine. Sir, I was supposed to maintain books of accounts, but I am not maintained. Is there any penalty for me? Yes. As per section 271A, a penalty of 25,000 would be levied, guys. Penalty of 25,000 would be levied. Now you might also ask me, sir, I am a person who is not covered under section 44AA. Can I still maintain the books of accounts voluntarily? Yes, you can maintain it. Next, section 44AB, which is an important section which talks about tax audit, that is income tax audit. Guys, you would have learned different types of audit, especially in company law, statutory audit, internal audit and all, cost audit. But that is different. What we are discussing here is income tax audit as per section 44AB. So who should get their books of accounts audited as per income tax law? Section 44AB makes it obligatory for a person to get his accounts audited before the specified date by a chartered accountant. So only a chartered accountant can do the tax audit. Within a specified date, he has to submit a tax audit report. What is that specified date I have given here? Specified date is 1 month prior to the due date of filing the income tax return under section 139 subsection 1. Guys, when tax audit is applicable for us, what is the due date as per section 139 subsection 1? 31st October of assessment year. And tax or audit report has to be filed at least 1 month before it. That means, can I tell it on or before 30th September of assessment year? Yes, guys. On or before 30th September of assessment year. Okay, sir. Then, who should get their books of accounts audited? First, if I am an assessee who is carrying on the business, if the sales turnover or gross receipts from my business is more than 1 crore, I should get my books of accounts audited. And now this limit has been extended to 10 crore subject to the condition. What is that condition? Aggregate of all amounts received and all payments made in cash does not exceed 5% of the said amount. Clear? That means my cash receipts should not be more than 5% and my cash payments should not be more than 5%. Sir, what if it is more than 5%? Then the limit applicable for me for audit is 1 crore. If I have satisfied both these conditions, that is receipts as well as payment, both is within 5%, then The limit applicable for me is 10 crore. And if I am an assessee who is following the presumptive scheme under section 44 AD, which is available for an assessee who is doing business, then audit is not applicable for me. Okay, sir. Next, I will just discuss this along with an illustration. Here I have given. Pay attention, pay attention. This is important. Assume the turnover or gross receipts of previous year 25-26 for an assessee is 6 crore, and out of that 20 lakh he has received in cash, and total payment made by him during the previous year is 4 crore, and out of that 16 lakh he has paid in cash. So you can check the receipt and payment in cash is less than 5%, guys. So 20 lakh divided by 6 crore, less than 5%. 16 lakh divided by 4 crore, less than 5%. So as both of them is less than 5%, what is the limit applicable for an assessee for tax audit purpose? 10 crore. And what is his actual turnover? 6 crore. It is within 10 crore. That means no audit. No audit. Okay. One more illustration. Now, the turnover of an assessee during the previous year 25-26 is 8 crore, and out of that 45,000 he has received in cash. Okay. So check 45 lakh divided by 8 crore. It is more than 5%. More than 5% is received in cash. Okay. Payment is 6 crore 50 lakh and 26 lakh is received in cash. If any one of this is more than 5%, then what is the limit applicable for assessee for tax audit purpose? 1 crore, guys. And what is his actual turnover? 8 crore. So, is tax audit applicable for him? Yes. Because the limit applicable for him is 1 crore and his actual turnover is 8 crore, which is more than 1 crore. So, audit is applicable for him. He need to appoint a chartered accountant in practice in order to do tax audit of his books of accounts as per income tax law, guys. Is that clear? See, gross receipts, turnover, and sales is all one and the same, guys. Don't get confused. Actually, for profession, we use the word gross receipts, whereas for business, we use the word sales or turnover, guys. Okay, sir. And I have also given few illustration for books of accounts purpose, guys. You can just go through this, which is very easy. Clear. See, for specified person, he need to maintain books of accounts in the current year only if gross receipt is more than 1,50,000 in all the 3 years. See, in this case, in this year, it is less than 1,50,000. So he need not maintain books of accounts. Whereas in the second illustration, all the 3 years, it is more than 1,50,000. So he has to maintain books of accounts. Whereas for non-specified person, whatever is the limit for income or gross receipts, it has to cross in any one of the year. And sir, should both cross? No, no. Either gross receipts or income. If any of it is more than the threshold limit, even in 1 year, they have to maintain books of accounts in the current year. Okay, I have given it here. Explain this. I will go back. Yes. So we discussed about the assessee who is carrying on the business. Sir, what about the assessee who is having a profession? If gross receipts from profession is more than 50 lakh, they have to get their accounts audited, guys. But if a person is covered under section 44 ADA, which is a presumptive scheme available for profession, then they need not get their books of accounts audited. Got it? Then 3, 4, 5, I will cover it later. It is connected to presumptive schemes. Okay. Now, sir, even though I was subject to tax audit, what if I have not got it done? I have not at all appointed a chartered accountant. In that case, there will be a penalty levied under section 271B. How much, sir? 5% of the turnover or gross receipts or 1,50,000, whichever is lower. Whichever is lower, guys. Okay, sir. Fine. Illustrations done. Next, there are totally 3 presumptive schemes which are covered in your syllabus. That is presumptive scheme for business under section 44 AD, presumptive scheme for profession under section 44 ADA. Then the last one is presumptive scheme for the assessee who is engaged in goods carriage business under section 44 AE, guys. What are those? We will see. First of all, sir, what is the purpose of this presumptive scheme? Guys, in the first part of our PGBP head, we saw what all expenses are allowed, what all expenses are disallowed. So if let us call that as normal provisions. So if assessee is computing the income as per the normal provisions of PGBP head, then he should know what is allowed, what is disallowed. And for this, you need to have a separate team altogether to take care of each and everything. Clear? Because if by chance, if anything happens, if anything wrong happens, assume he has incurred lakhs together or close together expenditure, which is not allowed to claim it, then it is a huge loss for the assessee. So you need to appoint some experts in order to take care of all this, guys. Okay. But for the assessee who is doing small business or profession, he may not afford to hire the experts and to consult. He may not be worried about what is allowed, what is disallowed and all. So in order to support small businessmen or professionals, they have introduced presumptive scheme under income tax law, where they need not worry about what is allowed, what is disallowed. Whatever is their sales or gross receipts, a certain percentage of that is considered to be their income, and they have to pay tax on that. That is considered as their presumptive income, which is nothing but business income. Okay. But if they object for it, telling, no, no, my income is less than presumptive income, then they have to maintain the books of accounts and get it audited and prove what is their income. Got it? Yes. So this presumptive incomes is to support the small business officials or professionals who may not afford to spend too much money on the experts in order to calculate the income as per the first part of PGBP head, guys. Clear? Yes, sir. So, and actually, something similar to this is also there in GST. If you guys remember, there is a composition scheme under section 10. Even there also, it is to support the supplier who is doing small businesses. Clear? Whose aggregate turnover is within threshold limits. Yes. Chal, fine. We'll learn this first. We will learn section 10 of CGST Act under GST. Yes, guys. First, presumptive scheme under section 44 AD. This section is applicable to resident individual, resident HUF or partnership firm other than LLP. For LLP, this is not available. Okay. Carrying on any business, but other than business referred under section 44 AE, that is goods carriage business, because we have a separate presumptive scheme for it, whose total turnover or gross revenue from such business in the previous year does not exceed 2 crore normal limit, but this limit is increased to 3 crore subject to limit. So assessee can enjoy the higher limit of 3 crore provided aggregate cash receipt in the relevant previous year is less than or equal to 5% of the total receipts, guys. Clear? If this condition is not satisfied, then the limit applicable for them is 2 crore. If this is satisfied, then 3 crore. Okay, yes. Now, sir, as per this section, what is the presumptive income? Presumptive income is 8% of the gross receipts paid or payable to the assessee, guys. So whatever is the sales, 8% of that. Remaining 92% is considered to be an expenses. Should the assessee maintain the books of accounts for it? Should he maintain a record for it and all? No, not at all required. Okay, sir. But if certain conditions are satisfied, instead of 8%, we will take 6%. Sir, what is it? Presumptive income under section 44 AD shall be calculated at 6% of the turnover or gross receipts or sales if the following conditions are satisfied. What are those? First one, turnover or gross receipts or sales is received by any mode other than cash. So it should be received in any mode other than cash. Sir, in what mode? We will see later. There is one particular rule for this. Okay. And the above payment is received during the previous year or before the due date of the filing return as per section 139 subsection 1, guys. If both these conditions are satisfied, then we will take 6%. If not, 8%. I have one illustration on this in my provision book. Just come to, if you have my provision book, just come to section 44 AD. Yeah. There in page number 115, I have given one illustration. Let me just quickly go through it. Turnover of a business for previous year 25-26 is 1.5 crore, out of which 80 lakh was received before the due date of filing the return of income in any mode other than cash. So on 80 lakh, what is the percentage, guys? 6% is a presumptive income. Okay. 30 lakh was received before the due date of filing the returns but in cash. So on that 30 lakh, what will be the rate? 8%. And remaining 40 lakh was received after the due date. And if you have received the amount after the due date, no matter in what mode you have received, the percentage will be 8%. So on this 30 lakh plus 40 lakh, the percentage of presumptive income is 8%. Whereas whatever you have received before the due date of filing the returns in any mode other than cash, on that it is 6%. So totally the presumptive income as per section 44 AD for this assessee is 10 lakh 40,000, guys. 10 lakh 40,000. Yes, sir. Yes. Coming back to this, we have some more points to cover. Yes. Now, the assessee who is following the presumptive scheme under section 44 AD, if he is liable for advance tax payment, then he will pay it in one installment on or before 15th March of the previous year, guys. Whereas others will pay in 4 installments. No, this person will pay it in only one installment. Okay, this is done to reduce their compliance burden. Okay. Then section 44 AD is not applicable for the following people. Who are those? First one, a person carrying on any profession referred in rule 6F, because for them The presumptive scheme is available under section 44ADA, guys. Oh. Then a person who is earning the income in the nature of commission or brokerage, a person who is carrying on the agency business. Guys, these two people have been kept outside section 44AD because for them the profit margin is more. So let them calculate the income as per the normal provision which we discussed in part 1 of PGBP. Okay. Then associate who is engaged in goods carriage business, because for them there is a presumptive scheme available under section 44 AE, guys. Okay. Then the last one. Any associate who has availed the exemption or deduction under section 10A, 10AA or 10B, 10BA, or any deduction claimed under chapter 6A heading C. Heading C means income based deductions, guys. So if an associate has claimed any of this deduction, for them presumptive income under section 44AD is not available. Okay, yes. Then the last point is important. If I am an assessee who is following presumptive scheme under section 44AD, I need to follow, assume for the first time I am going to 44AD. I need to follow section 44AD for this year as well as next 5 years, provided I have satisfied all the conditions given here. In any of the next 5 years, if I want to go out, they are telling don't come inside 44AD for next 5 years. That means, assume guys, once I come under 44AD, I need to follow 44AD for that year plus next 5 years. In any of these 5 years, if I want to go out, I can go out. But they are telling the year in which you go out plus next 5 years, you cannot come inside. You cannot come inside. And when you are going outside section 44AD, compute the income as per the normal provisions. And if your income is more than basic exemption limit, then maintain the books of accounts and get it audited. Section 44AA as well as AB, both will be applicable for an assessee, guys. Got it? Yes, sir. Next. Presumptive taxation for small professionals, that is as per rule 6F, guys. Okay. This section is applicable to resident individual or resident partnership firm, but other than LLP. LLP is not covered here. Okay. Engaged in the specified profession, which is given in rule 6F, which we already covered in section 44AA, guys. Same professionals are covered here. And whose gross total receipts in the previous year from such profession does not exceed 50 lakh, normal limit. But the 50 lakh limit is increased to 75 lakh subject to condition. That is, the aggregate cash receipts should be less than or equal to 5%. If cash receipt is more than 5%, then the limit applicable is 50 lakh, guys. Very similar to 4480. Here the limit is 2 crore. If cash receipt is within 5%, then 3 crore. No, same way here. It is 50 lakh or 75 lakh subject to condition. Sir, what is the presumptive income here? 50% of gross receipts. Remaining 50% is considered to be an expenses. Okay. And if the assessee who is covered under section 44 ADA, if he is liable to pay advance tax, then he has to pay it in one installment on or before 15th March of the previous year. Okay, sir. And if assessee is following this, it's okay. If by chance, if the assessee want to come out of presumptive scheme under section 44 ADA and want to compute the income as per the normal provision which we discussed in part 1, then we need to check what is their total income. If total income is more than basic exemption limit, then they have to maintain the books of accounts and get it audited, guys. They have to maintain the books of accounts and get it audited. Okay. Then last presumptive scheme, business of plying, hiring or leasing goods carriages, section 44 AE. If assessee who is carrying on the business of plying, hiring or leasing goods carriages and who owns not more than 10 goods carriages at any time during the previous year, then he is eligible for this scheme. Sir, what for one day he owned more than 10 vehicles? Then he is not at all eligible for it. He is not at all eligible for presumptive scheme. Okay, sir. So in case of heavy goods vehicle, sir, how do we call or how do we check whether the vehicle is heavy goods or other than heavy goods? If the vehicle weight is more than 12,000 kilograms or more than 12 tons, then we call that vehicle as heavy goods vehicle, guys. In that case, what is the presumptive income? 1,000 rupees for each ton of gross vehicle weight or unladen weight without any goods. Please be careful, this 12,000 kilograms is without any goods. It is only the vehicle weight. Okay. For every month or part of the month. Even a few days in a month, we need to consider full month. Okay. Sir, what if it is other than heavy goods vehicle? That means the vehicle weight is less than or equal to 12,000 kilograms. Then presumptive income is 7,500 for every month or part of the month for each vehicle. Clear? So this is presumptive income. And I told you that assessee should not own more than 10 goods vehicle at any time during the previous year. And here the period of ownership is important, not the period of usage. Now, if I own a vehicle for 10 months, but I have used it only for 6 months, should we compute the income for 6 months or 10 months? 10 months, guys. And even if I have purchased the vehicle on higher purchase basis, still I have not got the ownership. Should we still compute the presumptive income for that vehicle? Yes. I am considered as owner for section 44 AE purpose. And the assessee who is covered under section 44 AE, if they are liable to pay advance tax, they have to pay it in 4 installment as others. Others. Whereas the assessee who is covered under 44 AD and ADA, they will pay it only in one installment on or before 15th March. Whereas the assessee who is covered under 44 AE, they have to pay it in 4 installments. Got it? And if the assessee who is following 44 AE wants to opt out of presumptive scheme and they want to compute that income as per normal provision, then they have to maintain the books of accounts and get it audited, irrespective of their income. We don't even check whether it is more than basic essential limit or not, guys. Is that clear? That is actually was covered in 44 AA and AB, which I told I will cover later. So you can see here where the PGBP are deemed to be the profits and gains of assessee under section 44 AE and BBBBB is not a part of your syllabus, so you need not worry about these two sections. And the assessee claims lower income. So the assessee who is following section 44 AE wants to claim lower income than the presumptive income. Then straight away they have to maintain the books of accounts and also get it audited, guys. Get it audited here. Okay. Whereas the assessee who is following presumptive scheme under section 44 AD or ADA now wants to disclose lower income than the presumptive income. They have to calculate the income as per the normal provision. And if that income is more than basic essential limit, then they have to maintain the books of accounts and also get it audited. And please be careful, guys. Partnership firm is covered here under the presumptive schemes. Partnership firms are covered, right? Yes. But for partnership firm, the basic essential limit would be 0 because for them flat rate is applicable. Whereas for individual and HUF, the slab rates are applicable. So basic essential limit would be either 2 lakh 50, 3 lakh or 4 lakh under default regime. Or if they're super senior citizen, it can be 5 lakh. Clear? Whereas for partnership firm, it would be 0 because flat rate is applicable for them, guys. Okay, so. So done with all the three presumptive schemes. We have some common points for all the presumptive scheme. But before that, I have one question for section 44 AE from my question bank. We'll quickly go through it. Okay. Yes. So Mr. X commenced the business of operating goods vehicle on 1st April 2025. He purchased the following vehicles during the year, guys. Okay. First, totally how many vehicles are there? You check. 2 plus 1, 3, 6, 7, 9 within 10 or not more than 10. Exactly 10 also is okay. So is he eligible for presumptive scheme under section 44 AE? Yes. So these vehicles are other than heavy goods vehicle, whereas this is heavy goods vehicle because the vehicle weight is more than 12,000 kilograms, guys. Okay. So first, two vehicles are purchased on 10th April. So it is used for how many months? Including April. Even part of the month you have to take full. Okay, so it is used for 12 months. Okay, both the vehicles. Then one more vehicle other than heavy goods vehicle is purchased on 15th March. So that means it is used only for 1 month. So number of month is only one, guys. Then the vehicle weight is 10,000. So other than heavy goods vehicle, three vehicles are purchased on 16th July. So we need to count from July to March. July to March, 9 months, including July. Okay, sir. Then the vehicle weight is 11. Again, other than heavy goods vehicle, one vehicle is purchased on 2nd January. So we need to count Jan, Feb, March, only 3 months. Only 3 months. Okay, sir. So for all these vehicles, what is the income, guys? 7,500 per month or part of the month into number of vehicles. Into number of vehicles. We derive these figures. Okay, so next for heavy goods vehicle, when it was purchased on 10th August. So we need to count the number of months from August to March. So how many months, sir? 8 months. So what is the income? For each ton, totally 15 tons are there. For each ton, the income is 1,000 rupees. So 1,000 into 15 tons into 8 months. And how many vehicles are there? 2 vehicles. So multiply that. You will get 2 lakh for 2 lakh 40. So the total presumptive income under section 44 AE is 6 lakh 52,500. And later they have also mentioned one thing here. Would your answer change if the goods vehicle purchased in April were put to use only in July? No, guys. Because we need to consider the period of ownership and not the period of usage. Even though it is used from July, from when it was purchased from April, I need to count it. Clear? And then, if by chance, what if any goods carriage is sold during the year? For example, assume whatever was purchased in August was sold in September. Then we need to calculate number of months as 2. Part of the month is also counted as full month, guys. Even one day in a month, we need to take both. Okay, that is, we need to take full month. So in my example, we need to take August as well as September, both. Got it? Yes, sir. Fine. Now, coming to the common points for section 44 AD, ADA as well as AE. All deductions from section 30 to 38 or 37, including depreciation, will be deemed to be allowed, guys. But only to calculate the closing return on value of a particular block. To claim WDV or to calculate WDV, we can reduce depreciation there. But depreciation will not be allowed as an expenses because the assessee is following presumptive scheme. And assessee who is opting for taxation on presumptive basis are not required to maintain books of accounts as per section 44 AA, and they need not get it audited as per section 44 AB, guys. And in case of a partnership firm who is covered under section 44 AE, they can claim the deduction as per section 40B for interest on loan or capital, as well as the salary or remuneration paid by firm to the partners. They cannot claim any other expenses. Sir, what about the assessee who is covered under section 44 AD or ADA? If they are the firm, can they claim the deduction under section 40B? No. 40B deduction is allowed only for a partnership firm who is following section 44 AE. And it is not allowed for the assessee who is following 44 AD or ADA, even though they are a firm. So for an assessee who is following 44 AD or ADA, whatever presumptive income we are calculating as per the respective income or respective section is the final figure, guys. No more deductions. Got it? Yes, sir. Just a minute. Yeah, you can see here. Assume I am carrying on a business. I am following presumptive income under section 44 AD and my presumptive income is 10 lakh. Can I claim any expenses against it? No, I cannot claim. Even if I am a partnership firm, I cannot claim any expenses against presumptive income. Now, sir, what if I am a person who is carrying on a profession as per section 44 ADA, and as per section 44 ADA, my professional income is, or the presumptive income is 15 lakh. Can I claim any expenses against it? No. But if I am an assessee who is engaged in goods carriage business and I am following presumptive scheme under section 44 AE and I am a partnership firm, my presumptive income as per 44 AE is assumed 5 lakh. Can I claim the deduction as per section 40B? Yes, but limit and all will be applicable. That is maximum interest 12% and the remuneration as per section 40B or actual remuneration, whichever is lower. That limit and all will be applicable. But only this expenditure is allowed for a firm who is following presumptive scheme under section 44AE, guys. Okay, sir. So this is all about the presumptive scheme. Fine, guys. We are almost done. Almost done. Come on, pay attention. Guys, I know you are mentally tired. You are not able to sit. Sir, you are doing it for a very long period. Guys, you know this is the most important head. So please hold on. We are almost done. We are almost done. Treatment of business loss. Guys, for income tax purpose, for adjusting the loss, business is classified into 3 types. That is speculation, specified and all others. Okay, now what is speculation business, sir? When I buy anything and sell online without actual delivery or without physical delivery, we call it as speculation, like our intraday transactions and all. Okay, sir. So if I have any loss from speculation business, that loss can be adjusted only against income from speculation. It cannot even be adjusted against other business income. It cannot be adjusted against other heads of income. And it can be carried forward for next 4 years. And within 4 years, if you don't earn any income from speculation, then forget about that loss. Okay, sir. Then specified business, which we covered under section 35 AD, guys, for which deduction is given for any capital expenditure other than LGF. In that case, normally, as I already explained you, in the initial years, there will be huge loss. So any loss from specified business can be adjusted only against income from specified business. Clear? Sir, can loss from one specified business be adjusted against income from another specified business? Yes, it can be adjusted, but it should be specified business. And how long can we carry forward the specified business loss? For indefinite period, unlimited life it has, guys. Clear? And please be careful for adjusting the loss. Scientific business is not considered as special. Sir, then if I have any loss from scientific research business, where it will fall? Under other business, guys. Clear? And here other business includes all the businesses other than speculation and specified. Got it? Yes, sir. So if a assessee has a loss in the current year from any business which is not speculation or specified, he can adjust it against income from any other business, including specified business income, sorry, speculation business income, or specified business income, or speculation business income, guys. So please listen here. If an assessee has a loss from this business, can he adjust it against speculation business income or specified business income? Yes, it is allowed. But vice versa is not allowed. Vice versa is not allowed. Clear? I repeat. If the assessee has a loss in the current year from any other business, he can adjust that loss against income from any other business, whether it will fall here or specified business or speculation business. Okay. And if he is not able to adjust it within the same head, that is called intra, then you can adjust it against other heads of income except salary income. Business loss can be adjusted against other heads of income except salary. Okay. And if that is also not possible, the third option is you can carry forward it for next 8 years. And when you carry forward the business loss, you can adjust it only within the same head in the subsequent years. In the subsequent year. In the current year, you have both the option, intra as well as inter. Whereas once you carry forward it, you can adjust it only within the same head, guys. Got it? Yes, sir. Then, sir, what is the impact of default scheme for this head? If an associate who is following the default scheme under section 115 BAC wants to compute his business income, then the following three is not allowed, guys. What are those, sir? Additional depreciation which is allowed at 20% of actual cost for new plant and machinery which is purchased and installed in factory, that is not allowed. The associate can claim normal depreciation, but additional depreciation is not allowed. Okay. Then deduction for donation made to the outsiders for any research purpose. It is allowed provided the receiver is approved for the doing research, right? Yes. But the donor, that is the person who is giving the donation, if they are following default scheme under section 115 PAC, then this deduction is not allowed. Sir, what if assessee is incurring any expenditure for his own business, revenue capital? Can he claim it? Yes. For his own business, it is allowed. Whereas if he is contributing to outsiders, that is not allowed. Okay. Last one. Deduction in respect of capital expenditure incurred for specified business is not allowed under section 35 AD. In that case, whatever capital expenditure they are incurring, they can add it to the block and claim depreciation. But 35 AD deduction is not allowed for capital expenditure in case the assessee is following default scheme under section 115 BAC. And one more important thing, guys. If assessee has unobserved depreciation, he can carry forward it for any number of years and he can adjust it against any income except salary. And against casual income, you cannot adjust any loss or unobserved depreciation against casual income, okay, which is in the nature of winnings. Okay, but what is given here in the law is unobserved depreciation. First of all, what is unobserved depreciation? Sir, I have huge loss. Now, my profits of the business is not sufficient in order to observe the depreciation. So you can keep the depreciation as a last line item. You don't combine that with business loss because business loss has some restriction. So treat unobserved depreciation separately. And you can carry forward it for any number of years and you can adjust it against any income except salary. Except salary. And there is one key point with respect to this, guys, which I want to explain. Just a minute. Yeah. Assume, guys, in the year 24-25, assessee was following optional scheme. Okay, that is regular provisions of the act. He had an opening WDV 50 lakh and additions for more than 180 days during the previous year is 5 lakh. So total is 55 lakh. So you can claim normal depreciation. Assume it is a plant and machinery block, guys. It is a plant and machinery block. Okay. Yes. So normal depreciation is on 55 lakh, 15%. And please be careful, whatever new asset is purchased is put to use for more than 180 days during the previous year. So full depreciation. Oh. So, and additional depreciation is 5 lakh, that is on the cost of new asset into 20%, 1 lakh. Okay. So the closing WDV is 45 lakh 75,000 at the end of last year. Okay. Now total depreciation of an assessee is 9 lakh 25,000, but he is not able to claim it because he already have huge expenses he has incurred. So even before depreciation, he already has a loss, business loss. So we call this as unabsorbed depreciation. How much totally? 9.25 lakh. Okay. So last year he was following optional scheme. So accordingly he claimed additional depreciation. So can he carry forward it if he is not able to observe it? Yes. But now assume in the year 25-26 he wants to follow default scheme. Yes, he can do it. Now, how much unobserved depreciation he can carry forward and adjust it? So out of total 9.25 lakh, 8.25 lakh is with respect to normal depreciation. Can he carry forward it and adjust it? Yes. Whereas 1 lakh is with respect to additional depreciation. As now the assessee is following default scheme, additional depreciation is not allowed under default scheme, right? No? Yes, sir. But this is the amount relating to last year when he was following optional scheme, sir. Yes. He has claimed this, but he couldn't adjust it in the last year. Now he has brought forward it for the current year. In the current year, he wants to follow default scheme. And this additional depreciation is not allowed under the default regime. Now, can you adjust it against any income? No, you cannot. So what should we do for this? Add it to the opening WDV. So whatever was the closing WDV of the last year, no, that will become opening WDV in the current year, right? Yes. For that, we need to add back 1 lakh additional depreciation. So on this, in the current year, assessee can claim only normal depreciation. Normal depreciation. And this is an important adjustment, guys. So please be very careful. So last year, he claimed additional depreciation because he was under optional scheme and he couldn't adjust it, so he carry forward it as unobserved depreciation. But in the current year he wants to follow default scheme, so he cannot adjust this 1 lakh. So what they're asking is, please add back to your block. Last year it was reduced, right? Yes. So in the current year you add it back. You might ask me now, sir, what if assessee is continuing with optional scheme in the current year? Then he can adjust this 1 lakh against any income except salary, no problem. In that case, should we add it here? No, no, no. If you're adjusting it, then don't add it here. Got it? Yes, sir. Fine. And you might ask me now, sir, in the current year, whether you ask or not, I am asking myself. I know you are now, sir, already it's too long, sir, almost 3 hours. Don't have any energy to ask any question, sir. But I have. Don't worry. Listen here. Sir, what? After coming to default scheme, if you purchase any new plant and machinery in the current year and it is installed in factory, can he claim any additional depreciation against it? No, no additional depreciation. It is not at all allowed, guys. Okay, sir. Fine. So done. Last part in this hit, guys. That is, in few places, we saw expenses cannot be paid in cash more than so and so limit, or it cannot be received in cash, or maximum 5% can be received in cash, or maximum 5% can be paid in cash. Correct? No. So now, in what mode can we make the payment, or in what mode can we receive it, sir? Is given in rule 6 ABBA above. Okay. What is it? As per Rule 6 ABBA, the following electronic modes have been prescribed through which payment can be made or money can be received for the purpose of section given in the table below. Okay, so in what all mode can we make the payment or receive the payment is given here, guys. You can just go through this list. That is account pay, check, bank draft, credit card, debit card. Okay, I will only read it. Net banking, IMPS, UPI, RTGS, NEFT, BEAM. Oh, so in simple, you cannot make the payment or receive it in cash. That is what we use because we cannot write all this in every provision. Correct. And this rule is applicable for which all sections, sir? I have given the list here. Rule 6 ABBA is applicable for the following sections. That is section 35 AD, capital expenditure of a specified business. Then section 40A3 or 3A, that is cash payments. That is more than 10,000, you cannot pay it in single day for a single person. Yes. Then 35 AD also, whatever capital expenditure you are incurring for a specified business, no, you cannot pay more than 10,000 for a single person in a single day in cash. Okay. Then actual cost calculation for determining the depreciation. Then 44 AD. In 44 AD, we had a higher limit of 3 crore. No, that 3 crore is applicable subject to certain limits. Correct now that you should not pay in cash, receive in cash and all. Yes. In what mode can we receive or pay? It is mentioned. Okay. And even that 6% is applicable provided you have received money in any mode other than cash within the due date. Yes. So in what mode should I receive, sir? Whatever we discussed. Okay. Then ADA also normal limit is 50 lakh, but an increased limit of 75 lakh is applicable subject to limit. Clearer? That is, your receipt should not be more than 5% in cash. So remaining 95% I should receive in what mode? In any mode mentioned here. Okay, sir. Then 43CA and 50C, we will cover it in capital gains head. Guys, actually 43CA is a part of PGBP head, but it is connected to 50C. So both the sections I will cover it in capital gains head. Whereas 56 to 10, which talks about gift taxation, we will be covering it in the last head of income, that is income from other sources. Then 80JJAA is a deduction section. So you should know that for all this section, rule 6 ABBA is applicable, guys. Yes, sir. So finally, we are done with the most important head. So one thing, guys. So we'll just mark the section. We'll just mark the section. So whatever we have covered in this head is from section 28 to 44D. But everything was not a part of your syllabus, so you need not worry. And guys, I know somewhere you are feeling tired, somewhere you are losing your interest. But if you are holding your nerve till now, I know how serious you are about your course or the prefix which you want to add to your name. You started with the dream, yes, I want to become CA. And in this process, guys, I know the journey is not going to be easy, but please make sure at any moment you will not give up. Guys, we are made to be strong. So please make sure, however tough it may look like, please give your 100% and definitely trust me, you will be able to get it. Maybe in the past you are not able to do it. So you would have not passed in the previous attempt, but that's okay, guys. Forget about your past and move on. And you know better what you didn't do well in the previous attempt. So try to improve on it and give your best. And trust me, if you give your best, results will come your way, guys. Take care and prepare well.